Good morning, ladies and gentlemen, and welcome. Firstly, I'd like to say thank you, everybody, for coming. My name is Steve Torsa. I'm the founder of Wholesale Investor and Capital HQ. Welcome to our Venture and Capital Dubai edition. This is our third edition of this event. Our first one was in Sydney, then in Singapore, now in Dubai. Our last one will actually be held in India on December 2. So, for me, it's such a unusual thing for me, being an Australian, coming over and doing these conferences. It's exciting for me to meet people that have been in our ecosystem for a long time. And I'll just ask out of curiosity, who's been a subscriber to Wholesale Investor for some time now? All right, perfect. It's such an unusual thing for me, and it's great to meet everybody. And to give you a bit of an idea about who we are, everything we think about is how to empower innovation, capital, and ambition. And the core of what we do with that is obviously there's an online component, and then obviously there's an in-person component. And whenever we do these events, there's three outcomes that we're going for from your perspective. Number one, we want to provide you with insights as far as what's happening from an investment trend perspective, because right now there's a lot taking place. No, and obviously those insights come across venture capital, digital assets, and then also on the alternative side in private credit, which has obviously become very hot over the last sort of couple of years. The second component is access to curated opportunities. So obviously the companies that are exhibiting outside have been some of the curated opportunities, and there's a great range of companies, whether you're interested in agri-tech solutions, whether you're interested in renewable energy solutions, edutech solutions, cyber security solutions, etc., or just online marketplaces. We've got a range of opportunities that have been featured today for you to access. And then the last one is high value networking. And I know that's a big part of these events. You'll never know who you meet at our events and the incredible people, what they do, their backgrounds, and so forth. So they're the three things that we sort of focus on when we're actually doing this. And from a company perspective, about 12 months ago, I started the thesis, I just started communicating to everyone that I think right now is the best time that I've ever seen for investors in accessing growth, and also high yield opportunities. And there's a whole bunch of forces taking place at one time to actually make that available for everyone. But also there's a whole bunch of challenges taking place as well. So for me, the fourth part is then I want to share in my keynote, I'm going to be talking about some of my thoughts around AI and crypto as the fourth component of that. So for today, I'll just give you a quick high level. Obviously, we've all seen the sort of high level intros on all the sort of speakers coming today. I would like to say big thank you to Anna Schwarter for having her MD come over for Singapore to speak today. Carter is an incredible company, and obviously they've got great range of access to insights, as far as what's happening from an investment perspective globally, but also in the region as well. And also my good friend sitting here, John Sharp, who I've known since he was in Singapore, has now just recently moved here. I've learned so much from this man over the last couple of years. So I know you're going to love his presentation, and also you're going to love the panel sessions that we have as well. So that will be today, and obviously, as I mentioned, we've got a great range of different companies presenting. Inside the Capital HQ app, you can actually see a bit of a summary. Likewise, in the email that we sent you today, you've got a bit of a summary on the companies that are presenting as well. Make sure you go and have a chat to them. My thesis for this is really simple. Even if a company may not be relevant for you right now, they may be relevant for someone in your network. So please, feel free to provide introductions and networks. And I'll give you a perfect example. We just had one of our medtech companies raise $25 million from an investor they met in Singapore that they ended up basically raising the capital out of India. But it was actually through one of my shareholders who's based in Australia that made the connection. So it's a really strange scenario, but that's the beautiful thing about an ecosystem and how it actually unfolds. So all that's inside Capital HQ. There's a whole bunch of other stuff. This is my final note. The power of one conversation can absolutely change the trajectory of a business and change the outcome potentially of an investment as well. And this is what I love about this space, is it enables opportunity. These are the upcoming events that we have. Okay, I don't think you will be flying over to Australia for our AI summit, but that's going to be a whole bunch of fun. But, if you've got any networks in India, then obviously I would love to welcome them to our Venture and Capital India event that we're going to be hosting. It's our first event that we're going to be hosting in Bangalore. So obviously the usual disclaimer, I even put a nice bright red light on there for everyone. So if you want to read that, feel free to. I can send it through to you. So now onto my keynote. This is where I get passionate about what's coming up. As I said, I've been in this space for 16 years. We started as a magazine, we then moved to doing in-person, and then we built our own sort of software solution. I've never seen a time like this with how fast it's moving. And there's always that sort of underlying thought that people keep on having is AI overhyped? If you really think about 3 years ago, nearly two, I've got up there 2, but it's nearly 3 now, absolutely what the possibility for an individual to achieve absolutely changed. And our predictions that we sort of had 2 years ago for what comes next centers around these sort of core factors of, number one, and this is what you're seeing now a lot through the ecosystem, take outside, some of the AI companies you're seeing, a lot of the sort of software-based startups, I would say 3 years ago, every startup was coming to me telling me that they were raising 5 million and above. Now everyone seems to be raising $500,000 to $2.5 million. Companies need a lot less than what they did previously. Likewise, the destruction of middle management. You're seeing that every single week. You're seeing new announcements about tech companies letting go of people. Next one is small teams can achieve incredible things. People are now 3 to 5 times more productive. And that's just with AI agents, that goes to a whole other level. I think in the next 24 months, the productivity of what you can get with utilizing things like AI agents change everything. And when someone who's non-technical like me can actually build agents with prompts, it's game over. There is so much possibility with what can be done. So the interesting part, when you think about how when someone's looking to create productivity inside of their business, previously they would go and see the HR department, or if there was a gap inside of their company. Now, the solutions they're looking for, they're going to their technical team, right? Because with all the different range of technology and software and AI solutions coming out, it is very highly likely that there's a software solution that is relevant to actually solve that problem. So the CIO, the technical team will be first, and then the HR team will be second. Now, the outcomes of the AI revolution, and you may not be able to see that from back there, but in it, I just give examples of all the different scalings of all the tech companies that are coming out, which is absolutely insane. Where someone like Cursor went from 1 million to 100 million ARR in 21 months with less than 50 employees. That is nuts. Companies like Fixer, who I'm a big fan of, right? The fact that they were able to go basically projecting 30 million. I think they've actually surpassed that now by the end of 2025. GemSpark, as another example, hit 36 million in ARR in 45 days, right? Lovable. Who's used Lovable before? Okay, only a few of you. Okay, well, I strongly recommend everyone try Lovable. It is good fun to see what you can possibly build. You won't probably be able to implement until you get a technical person involved, but it's absolutely incredible with what you can actually do with it. And then companies like Replit and Midjourney, absolutely smashing it out of the park. What these companies are doing right now has absolutely changed the profile. When you listen to all the podcasts and all the communications coming out from the VCs, all their previous metrics that they would look for in a SaaS company or in a subscription-based business are completely out the window because of what's taking place with some of these companies. But the interesting thing about this is history does actually provide a reference point for what's actually about to come down the pipeline. And this is why, for myself personally, I am so bullish about what comes next. And a lot of this work was actually done by Kathy Wood and the ARK Invest team. And it's really interesting when they provide a sort of snapshot of how low growth rate was before the second industrial revolution. And if you look at the technology, and basically what their thesis was, is when there's a convergence of technology platforms, it has a multiplier effect on the productivity that takes place globally, in the ecosystem. And what was really interesting was when they were doing their research, they highlighted that during the actual technology revolution of electricity, the internal combustion engine, and telecom, that effectively those three combining forces had an impact of actually 2xing global productivity. what's interesting is that combination of that enabled mass production, urbanization, and then also global trade. And then on the side of that was all the complementary innovations that were created off the back of that, whether it be around steel production, chemical industry, urban infrastructure, as gives the example of electric street lights, but then all the new value chains that were created from that. Right now, there's 5 technology platforms that are all converging and all going through their sort of S-shape, S-curve adoption phase. And the ones that I'm highlighting in this, whilst I said there's 5, the 3 that I'll highlight that are super interesting for this from a presentation is AI, robotics, and then also energy storage. The prediction is that effectively the combined GDP impact of all the technology convergence of these, and by the way, innovation, by its nature, effectively is deflationary. So if you think about this add-on as far as adding anywhere between $7 to $19 trillion worth of GDP impact by 2030, it gives you an idea of what to expect from a growth rate. And you're already seeing this take place in markets like the US, where they attribute a lot of the growth to what's actually happening on the AI front. So then the hardest part about this is right now there's an absolute ton of noise, right? There is so much information coming out, and it's really hard to figure out, like, what is the actual direction. So for me, I'm very simple in the way I think. I just want to understand where are things going so that basically I can build a business that's sort of relevant to that, host conferences, provide, sort of thoughts in those sort of areas. And the easiest place that I landed is if you actually watch where the hyperscalers are investing. That really helps you understand what is required, what is needed, and where the actual innovation is really taking place. So the interesting thing about all the hyperscalers is they are absolutely throwing their balance sheets at AI infrastructure. And what used to be called data centers is now called AI factories. And then you think about all these different aspects, and you look at that, and you think about how much they're actually investing and the rate at which it's increasing. And just to be clear, there's actually been, I did this, I think it was 3 months ago. I could actually add to this slide now because there's already been new announcements made as far as how much has been invested into it. And by the way, that's just the big 4. That's not including OpenAI. That's not including all sort of ones on the side of that. All these latest deals that OpenAI are announcing with NVIDIA, etc. This chart is not actually including that. So it gives you a bit of perspective. So the 3 key areas where they're investing is obviously in the semiconductor GPU chips, the data centers now called AI factories, and then energy. And the interesting thing is when I actually broke down all the stats, that effectively the number one focus for a lot of it was nuclear, then natural gas, then renewable energy, and then the last one is the energy storage solutions. Now, being an Australian, we don't allow for nuclear energy, so pretty much we're going all in on the renewable side, and there's still a lot of sort of natural gas, but there's challenges sort of associated with that. But the dual frontier for AI is not just the software part that you see. There's 2 elements. There's the digital aspect, and then there's obviously the physical aspect. So the digital aspect, we all know, we likely experience every single day, whatever LLM you're using, whether it be ChatGPT, Anthropic, whatever it may be, right? The physical AI you can see coming down the pipeline on the robotics front, and that's taking all sorts of various forms. But the really interesting part is that from the geopolitical perspective, that effectively the US and China have both planted their sort of stake in the ground that they both want to be technically dominant and also energy dominant, right? And you can really see that coming out of the administration, where it's not so, where previously all the mandates were all just about renewables, where now it's absolutely focused on getting as much energy capacity onto the grid as possible to feed it, because effectively the ambitions for whether it be digital or physical AI all require energy. And so when you actually break down, and by the way, I said it was about 2 months ago that I did this, but I'll do an update sort of shortly. When I did the research on how much energy has been announced by all the hyperscalers, basically it broke down to 24 million homes worth, average 24 million homes of capacity of energy has been sort of put on mandate to actually be pumped into, into the market over the next sort of 15 years. Right, so by 2040. And when you look at, and when you actually break down the types, as I said, nuclear first, renewable, natural gas, geothermal, which is an interesting one, and then energy storage, which is obviously the big investment and probably one of the fastest sort of growing areas at the moment. And there you see the examples that are used in that. So this stat come up a few months ago, and I thought it was really interesting as an example. And this is what the US is actually trying to change. They're really effectively, China obviously had foresight into this, and they've been getting, you can see the energy that they've been making available onto the grid and how much they've been increasing it. The US has effectively been fat. That is exactly what they're trying to change. So that's on the energy front, watching what the hyperscalers are doing. And then for me, when I think about this other part, I always have this sort of thought that sits in the back of my head is, what does the actual future of work look like? Because it just doesn't go away. You can see, like, any AI consultants that get up and say, oh, no jobs will be lost to AI. Like, I just don't know how you can say that. Like, it's literally been happening for the last 2 to 3 years. How many jobs have been lost to AI? So then the interesting thing is what does that future of work look like? And so to me, in sort of trying to break it down, and by the way, for me, I'll probably spend anywhere between sort of 2 to 3 hours sort of on content, understanding where this is going. But effectively, if you think about it, really an employee's role goes from actually doing, and the best way I explain it to my team is that right now, AI doesn't start anything and it doesn't finish anything as far as the overall sort of quality proof of what comes out, right? Someone still needs to do that, but it can do all the middle work in between. So then you can imagine, one of my team members joked about that AI is basically the meat in the sandwich. But effectively, the orchestration of checking the quality outputs, I can now see that take place. When someone like me, who's an absolute, non-technical, cannot code, cannot do anything, can build AI agents. Literally on the flight over here, I was building AI agents and just sitting down thinking, okay, what is slowing me up? And then building AI agents to actually solve it. If you're wondering what I'm using Lindy.ai. So the impact is that effectively team members, their role will change going forward, because effectively, instead of actually doing all the work, it's more about checking. And so then the productivity of each team member completely changes. So what that means is that for every company, it becomes new product opportunities in what they can actually create for their clients. They can create hyper-personalized products for their clients, and you're seeing that now with a lot of the different products that are coming out because of how easy it is to build. And then the outcome, as I mentioned, is that, and I said this 2 years ago, that we are going to see some of the most profitable companies in history being created right now. Right now, we're seeing some of the most fast scaling companies. That is going to transfer into being some of the most profitable companies in history. And what's really interesting is now some of the stats are coming out talking about how long the adoption took for the internet, right? Versus how long crypto adoption took, versus how long AI adoption took. And really, that's the power of the internet and network effects that go along with it. And also, you're seeing the cost reduction with the training of AI models that go along with that as well. So the scaling of these products absolutely is transformational because of that network effect aspect to it. So this is my favorite quote. I'm going to keep this up until it's actually achieved. But Sam Altman said, one stage he's got a friend group where they've got a bet on when the first $1 billion, first unicorn company is going to be achieved with just one person. And that's an interesting thought, and funny enough, what's one of the things that people overlook? I was speaking, one of the companies here today is building an AUD stable coin. Like, I was listening to a podcast where they were sort of referencing Tether for someone like JP Morgan, where they're explaining the value of Tether is basically because it's raising capital at $500 billion, its value is at $1.7 billion per employee. Whereas JP Morgan's value is at $1.7 million per employee. And it's crazy when you think about, when you put it into those sort of numbers perspective, and that's on the crypto side, right? There's a reason why all these deals have been done with OpenAI. And obviously I said, it's so for me, I don't think it's overhyped at all. Some of the valuations, you could argue against, but as far as what's going to be possible going forward. So my signals for the future, and once again, I said I try and break things down to the simplest as far as what do I think things are going to look like going forward. I landed on 2 companies, which I think, and obviously, you could reference a whole bunch more, but the 2 companies I landed on, I'll talk about AI first. So on the AI side, the way I simplified in my brain as far as what I'm trying to watch for, basically I'm watching all the product releases from OpenAI because I think OpenAI have done the best with the productization of AI. They typically lead with a product, and then most of the other LLMs typically follow, right? And you see the way that's been a common trend. They release early, and then you see the likes of Anthropic, Google, etc. release afterwards. Anthropic, I'm focused on what they're doing from a development perspective. Their AI coding tools and what they're doing for the enterprise. So far, they've been a real sort of standout leader in that area. Google's DeepMind, their medicine and health breakthroughs, they literally had one, I can't describe it, but basically they had a breakthrough where in the data they saw something related to cancer literally last week, and then it got verified in trials. And you sit there and think, is the actual cure for cancer going to be founded by something like a Google DeepMind or inside sort of Microsoft AI team going forward? Because they don't have the immune system that the big pharma companies have, right? So it's interesting when you think about that. So between medicine and health, following Google and DeepMind, and then quantum computing. But the truth is, Google is absolutely smashing it on all fronts on the AI side. If you've used their Gemini product, if you've used their AI studio, if you've used any of their sort of back-end stuff, it is unbelievable what they're doing. And then obviously NVIDIA, they're really setting the benchmark from the chip performance perspective. So if I'm trying to understand that as an area, pretty much it's NVIDIA. The other one that when I mentioned that there's 2 companies where I'm trying to understand what does the future look like, Google's the obvious one. So if you look across all the various areas of Google across, and obviously a lot of that sort of comes out of the sort of DeepMind labs, they're across robotics, they're building their own TPUs, they've obviously getting breakthroughs in the medicine area, they've obviously got their own sort of LLMs, they are the actually inventor, of the GPT, etc. So, that's one of them. The other one, which I sort of like to mention, and this one's a bit controversial for some people, out of curiosity, who hates Elon Musk? See, there's always a couple people. So what's really interesting about it, when I sort of really thought about it, if you actually have a look at what Tesla's doing, what Starlink is doing, what he's doing with Neuralink, what he's doing with SpaceX, from the Starlink, across all those areas, you can actually get a bit of a vision for what the future looks like. I can imagine what it looks like when you go outside and you see cars driving around and there's no humans in it. There's no human driver in that car, right? Obviously, Waymo started it, but they have to fit out that car with $120,000 worth of equipment that Tesla doesn't. So what they're doing, with their full self-driving 14 release, I strongly recommend you watch YouTube videos on that. It is mind-blowing what it is, right? So the combination of autonomous everything. Also, people miss their energy business. Their energy business is doing over 100% year-on-year growth. They are absolutely smashing it on the retail front and also on the commercial front, right? And then the last one is obviously they were building their own chips before. I should tell you that because they've actually stopped doing that. But what their relationship with AI, with Grok, right, and with XAI, Starlink, and just their ability for mass manufacturing really helps you understand that in the future, it's all likely we're going to have our own sort of humanoid robots in our homes doing all the stuff that we don't want to do every single day, combined with basically something, a vehicle, a robot driving us to work, doing all the things that we don't want to do, etc. So you can see what the integration of physical and digital AI looks like when you look at it. And then the advantages that they have is that they have 4 million cars that are providing real-world data for them, and they've got billions of kilometers worth of data. They've got deep vertical integration, obviously got mass manufacturing on the scalability front, which Google can't do. They actually have to do it on the outside. And then obviously the ecosystem synergy. And it really starts to make you think is, what does a future business model look like? Because that Tesla car that you may buy in the future, you may get it to drive you to work, but you could also go and send it out to be a taxi for the rest of the day. So then you think about it, if you're going to do it with one, why not do it with five? And then if it's going to be driving for you all the day and working as your taxi during the day, the detail that most people missed is that it also has, if you think about the connection with Starlink, the potential for it to do compute during the night also creates another revenue opportunity. And that's where the integrated part comes in. So, this whole sort of space is going to be super interesting over the next 5 years. This was an example that was done a couple months ago where they showed when basically Waymo actually started out delivering on Lyft as far as how many people that it takes around in San Francisco. You can look at the market share that it's already taken. That will happen right across the board. And then if AI commoditizes software, how will companies actually build moats? And that becomes interesting because right now you can see the value of software is going to zero, right? Because it's becoming a lot easier for people to actually build software and actually build live products. So then the next moat creation for companies becomes around data dominance, network effects and ecosystems that they build, and then also domain expertise and specialization. That's going to be the new playground for a lot of these. And once again, if you look at Anthropic, the way in which they move towards focusing their solutions towards enterprise, it's a really interesting strategy from their part because they saw that OpenAI was dominating on the consumer front. On the crypto side, another passion topic of mine. It's watching Bitcoin. It's really interesting to see. And by the way, I did this presentation initially at the start of the year. And because obviously this government was very pro crypto. In fact, what was interesting in the US elections alone, it was actually the crypto ecosystem that put in the most money to fund the US election campaigns, which is absolutely insane for an ecosystem that's had very little support and actually had government regulators trying to shut them down and kick them out of the country at that time. So if you look at this, the US government support of crypto is a strong start. The next stage is then you're seeing all the different corporates adding crypto to their balance sheet. They've seen what Michael Saylor has done, and also with Bitmine as well. And now there's actually over 70, and there's probably more now, 70 public companies that are actually holding crypto on their balance sheet. And more will start to follow that trend because they're seeing the results. They're seeing the results of what these companies are doing. And then the last one is people are always asking, when's that moment, where we get, wide scale adoption? Well, the institutional adoption is here, right? And the second part is the retail adoption is as well, because I don't know what it's like. Obviously, Dubai has become the crypto-friendly center, of the world. From an Australian's perspective, if you're trying to buy more than $10,000 worth of crypto, the problems that you would have frauds. You'd have the fraud department of the bank calling you. They would shut you out of your accounts. You'd be getting phone calls from them, and they would create all these hassles for you for buying crypto, right? Well, now you can just go and do that through your trading account through the ETF products. And obviously, there's a rollout of more and more ETF products as well. So for me, I'm very bullish. And whilst I respect that we're sort of, in the sort of latter parts of the bull run at the moment for crypto, I'm very bullish, and I think Michael Saylor says it best. No one ever lost money holding Bitcoin for longer than 5 years. And I think if you take that sort of longer term approach, you're dealing with an asset class that's got network effect going as well. It's got complete scalability. And then with something like Bitcoin, obviously it's got scarcity attached to it as well. But the products that are being created around the likes of stable coins, as an example, the more I listen and more I think about stable coins, it is probably the future of what banking will be like from an experience perspective, in far as how people actually do it. And Tether, crazy amount of profit with just 200 employees. That's actually increased since then. The real one that blew me away was finding out that stablecoin transaction volume surpassed Visa and MasterCard. I actually didn't know that. So for understanding as far as how much volume is going through on stablecoins, it gives you a bit of perspective. And then the last part is now stablecoins are also playing a powerful role in the purchasing of US treasuries, because there's so much money flowing into them that part of what they have to do is they have to back up with US dollars. So they're purchasing more and more US treasuries and actually becoming a lead sort of buyer of them as well. So stable coins are absolutely fascinating. So basically the landscape for this year, stable coins, the AI crypto convergence, it's really hard to beat. Basically the S-curve technology adoption that you have with both of those assets, with AI and crypto and then the network effect that goes along with it, the tokenization of real-world assets. When BlackRock put out their thesis around this, when the chairman put out about how he's going to be focused on this as an area, pretty much when BlackRock put in their ETF application, that's when I knew an ETF for Bitcoin was going to be real. They really do set the stage for this. So you're going to see the tokenization of real world assets will become a powerful force over the next sort of 5 to 10 years. Obviously, decentralized physical infrastructure networks, or decentralized, I should say. That's what I was talking about with the Tesla cars, about doing compute at nighttime. Because of the sheer requirements of compute, you're going to have centralized requirements, and then also going to be the corresponding decentralized compute applications as well. And then also the building of the digital wallet infrastructure. All the successful crypto, all the crypto trading platforms are all focused on what that future wallet infrastructure looks like as part of that sort of correlating with what does the future of banking look like? What does the future of finance look like? And again, you can see that force going forward as well. So that's it. So I didn't realize that was my last. Normally I got my deal. So this is the first time ever that I've actually finished a presentation within time. I've still got a minute and a half to go. So, I know I put out a lot. This is an area that I'm really passionate about. And I said, I love what we do as a company. I love shining a spotlight on the companies that we present. So I'm going to hand over to our host in a second. The one thing I just want to highlight, I mentioned at the start of today's event, one conversation can change the trajectory of a business. Also, I want to mention that every single company that's presenting here today has actually flown in here today, whether it be from the UK, whether it be from Australia, whether it be from some other location, they've actually flown here to participate today. So take the time, have a conversation with them. If they're not relevant for you, they may be relevant for someone in your networks. And as I said, one conversation can make a big difference. Ladies and gentlemen, thank you for coming to Venture and Capital Dubai. I appreciate it.
So thank you again, Steve, for what was a powerful and insightful kickoff to our day. So good morning, everyone. My name is Georgina, and I am your host and MC and your guide for what is going to already prove to be a fantastic conference ahead. Okay, so Steve has already set us off perfectly, setting the stage for what is going to be our first panel session, which is the Venture and Capital Investment Trends panel. So please give a warm welcome as I welcome our panelists to the floor. We have Anushaweta Mukherjee, who is Private Funds and Regional Lead for the Middle East and Africa, Carter. We have John Sharp, Managing Partner for Hatcher Plus, and of course, our very own Steve Torso, who is the founder and CEO of Wholesale Investor.
Thank you, John. Good morning, everyone. My name is Anushaweta. As our host so kindly introduced me already, as she said, I am the regional lead for Carta here in the Middle East and Africa, looking after our business vertical specifically for private funds in the region. Before I let our very esteemed panelists introduce themselves, maybe I give a quick overview of Carta for those of you in the room who don't know us. Carta essentially is a service and a software platform that connects the three nodes of the private market ecosystem. So think the founders or the companies to the investors and the private funds and to their LPs. In terms of credentials, we have about 50,000 portfolio companies on our platform across 160 countries worldwide. They use us for cap table management, valuation services, and so on. On our private funds vertical, we have about 9,000 plus private funds and SPVs that represents over $160 billion of assets under administration. And last but not the least, on the LP side of things, we have about 200,000 LPs just on our platform. So yeah, very excited to be here, very excited to be moderating this panel. And I'm going to pass it on to John and Steve. Well, I don't think Steve needs to introduce himself again, but you know what, John, why don't you kick us off with a quick introduction on you and perhaps Hatcher Plus while you're at it.
Sure, thanks very much. And we're users of Carter, by the way, so we're very familiar with you guys. And love Peter Walker. He's fantastic insights. So my name's John Sharp. I'm the co-founder of Hatcher Plus. Hatcher started as a venture capital company back in 2013. And by 2016, I was deeply convinced that venture capital was the most data-free, process-free business I'd ever been associated with. And so myself and my partner started building some AI and a process automation to take care of that for ourselves. And then during COVID, around about the same time as as just pre-release of ChatGPT 3, people started finding out about us and thinking, I should automate my venture capital business. I should create some robotic process automation around my fund admin or my asset management business. And our commercialization started for these tools that we do. So now with Hatcher, you can create funds, you can build tech stacks, and you can invest using AI. Those are the three things that we enable, and you can just go on hatcher.com and download that and use it for free. So that's what we do, but we also have a venture capital fund with 430 investments in it that's doing quite well. The second cohort of our second fund is in the top 3% of venture capital funds globally, which we're very pleased about. And so we know a little bit about that after 15 years of doing it, but there's still mysteries involved in venture capital, which I'm going to explain during my keynote later on. We've done a lot of research in that area to kind of try and demystify it, and hopefully I'm going to share that with some of you investors today, and maybe you'll be able to pick up some insights from what we've found during our research.
Just in case anyone else has walked into the room after Steve gave that presentation.
So obviously Steve Torso, Wholesale Investor. I suppose I'm fortunate enough the position that I'm in, I get to see a lot of opportunities. Like every day I'll speak with anywhere between sort of 8 to 12 founders and fund managers. And, you know, the perspectives which I've been able to see as far as from a trends, I think are super interesting. Like I said, I've been in this space for 16 years. I've never been as excited as what I am now about what's coming down the pipeline and the opportunities for both investors and founders in that.
Amazing. Okay, we're going to drill into that point. But okay, before I start off with actual panel questions, I want to start this with a global pulse check. You've done a great job already of giving us that presentation, but I think we are navigating a very unique macroeconomic environment right now, globally, regionally as well. So I guess I'm going to start with you, John, right? If you had to tell us, what do you think is the single biggest inflection point or challenge that will be defining the global venture landscape in the next maybe 12 to 18 months? So maybe the next year and a half. What would that be for you? And Steve, you're going to be thinking about that as well, and then giving me an answer on that.
I think Steve already sort of painted the road for this, but look, obviously it's AI. I mean, someone was saying on LinkedIn yesterday that $27 billion has been invested in the last year, and they can't see the point of investing all this money. And I'm thinking to myself, that's 3% of G42's budget. Yeah, less, right? So give me a break, right? 27 billion is absolutely nothing in the grand scheme of things. And if you look at the billions that it took to create the defense industry, the space industry, the health industry, the food industry, the car industry, all these massive industries that we now take for granted, these were tens of billions, hundreds of billions in their day, the railroad industry. So the amount of money that's been spent on AI to date is nothing, and the benefits that we're seeing are unbelievable. Right, so my business runs on AI. I would have to have 20, 30, 50 more people to do it, and I wouldn't be able to achieve scale without it. And the insights that AI enables you to pull from the rest of the world, from Carter Research, from all these other people that do research is phenomenal. It synthesizes this approach. If you notice when you search on Google, it gives you lots of different references to different individual sources of information. When you search for a question on ChatGPT, it synthesizes an answer from everything that's ever been discussed in that area. These are two entirely different beasts. It's a different mechanism. So ChatGPT is synthesizing me an answer for the entire world, And Google is giving me a collection of stuff, including several sponsored links that I've got to go through on the first page before I get to the first answer. So what AI is doing is giving me a synthesis of all the knowledge in the world. And that's not just me. That's any worker on my team or any worker in a factory somewhere that needs to understand how to do something. They get an instant answer, which is, I mean, think of how difficult it used to be to find a user manual for your washing machine. And now you go on ChatGPT and say, my washing machine seems to be making an unusual noise. And it will give you all of the information on exactly that model of that particular piece of kit. So the synthesis of knowledge that is available to us now is phenomenal. So for me, it's AI.
Beautifully put. But Steve, I'm going to throw another angle to this, if that's okay. I know I'm putting you on a spot here, but you have exposure, and you just spoke about all the different countries in which you've been hosting these events at, right? So how would you also, on top of what John just said, how would you kind of describe the current evolution of the UAE venture market or the UAE venture capital market so far, and how it differentiates from the other regional hubs such as the Londons, the Singapores of the world?
You mentioned the two perfect countries for that. So the best way I can describe what I feel like when I come here is that I feel like right now Dubai reminds me of what Singapore and the UK were in 2014. Like there was just so much, like here, just look around. Like this is the melting hub of what, like why I think why I love this city is that it really does exemplify what innovation, capital, and ambition actually look like. So, and it's also still very early days. The first time I came to Dubai was actually in May this year. And I had this perception that it was likely built out. And then I realized as soon as I come here, as soon as I went around, spent time going around, there is still so much more opportunity going forward. And then likewise with the region, everyone wants to come here, as far as from companies in Australia, companies in the UK, everyone. It exactly reminds me of back in 2014 when every company wanted to either go to the US, Singapore, or also to the UK. That right now is the Middle East. Now, to answer the first question, because I think I'm going to give an insight, like for me, I think Raoul Pal's content around this, where he talks about his sort of everything code, I think is a really good content for what to look for from an investor standpoint, is the combination of the interest rate reduction as far as being signals, because the more interest rates gets reduced out of the US, obviously the more money that's going to be coming off the sidelines and then back into the sort of ecosystem. And then also the common thing he's been talking about is that there's a strong correlation between asset values and the amount of sort of liquidity that governments are pumping into the system. Now, given all the sort of major developed nations have to actually refinance their sort of outstanding debts over the next couple of years, there's going to be a whole bunch of capital raising going on and a whole bunch more money sort of coming into the ecosystem. So once again, my thesis around why I'm so bullish for growth, high growth, and then high yield, I'll say the high yield part really relates to Australia. Australia's interest rates aren't coming down any soon. I'm a bit bearish on our Australian government, but that's a whole other discussion. Any Australian will understand this reason. But actually, part of that is it does mean that there's a massive opportunity in private credit in Australia, which is, for us as a company, 50% of our clients now are fund managers, and a lot of that relates to investors being able to access sort of high yield. So the foundations are there. Those two aspects that I mentioned, as well as potential for interest rates coming down, global liquidity from governments needing to raise capital to sort of pay, for their sort of refinance their debts. That is just fuel to a fire. And you add AI on top of that and the convergence of all the different technology platforms, it's an exciting time to be in this space.
That's very, very well put. John, would you like to add anything or?
About Australia? No. I think I very much concur. So I just moved here from Singapore. And so people sort of say, well, why have you moved to Dubai from Singapore? I mean, Singapore's got a great startup ecosystem. Singapore's very known for being very modern and what have you. But if you look at the AI landscape, our business is based on AI. If you look at the AI landscape, the top AI center of the world is still the US, right? And particularly like the south of the US. So that's where all the data centers are. Guess where the number 2 is?
UAE.
Right here. Guess where the number 3 is? Next door. It's just in Saudi yesterday in Riyadh. If you combine the Saudi and the UAE AI capabilities, it's bigger than the US. Can you believe that? So why am I here? I'm here because I want to be right next to that. And the AI centers are here because they need to be right next to the lowest cost energy in the world. So who wins, the UAE versus the US, in the energy cost aspect of AI? But this is massive. People don't realize that AI is essentially just transformed energy, right? You're asking a question, it cycles, it uses electricity, it gives you an answer. So the best place to be in the world right now is the UAE, right next to low-cost energy, next to the availability, the best availability in the world of solar, which the UAE is spending a lot of money on developing, and they're really dedicated to it. So this is the hub for AI going forward, in my opinion. That's not the only reason I moved here. I love the place. But from a business perspective, I think that's a really good reason to be based here.
So I concur to all those thoughts. For someone who's kind of not born, but brought up here in the region, it's really exciting to see the way the region's growing, Dubai, Abu Dhabi, and the UAE in general, and that kind of flows into the overall MENA region as well. So I'm going to stick with you, John, because my next question is really bringing in insights on how you currently use your data-driven approach to investing in the VC space. So how do you think and you touched upon this, but how do you think the UAE is positioning itself as a hub for technologically enabled venture capital investing, whether it's when they're using AI, which you already mentioned, but also data analytics to actually enhance the investment decisions they're making? How do you see that in the VC space right now?
Yes, I think Steve's presentation, great question. Steve's presentation touched on this in that, if you're a startup right now, you absolutely have to have access to AI, which means you need to be in the US or here or China to make your business work. And so obviously the kind of what the UAE has said is they want 10,000 AI-enabled companies in place by 2030. I don't know if you guys know this, but this is government policy. This is the Minister of AI. So 10,000 startups that require capital, employees, access to data centers, access to data, are going to be created in the next 5 years. That's another astonishing reason to be here. So obviously that's one trend. And now you look at what's underpinning that, or what kind of businesses these will be. This is also an energy hub. But how many people live in the UAE? Yeah, lots, right, that are here. Every one of you, so I'm a relatively new resident, been coming here for decades, but I'm a relatively new resident. And someone said, why are you walking to the supermarket? Just order stuff from noon, right? And I'm like, yeah, I shouldn't walk to the supermarket. It's hot. So I started ordering stuff on noon, and now I'm totally addicted. This is a delivery and logistics amazing place to be, right? It's probably one of the most amazing places to be in the world. It's an amazing, centralized kitchen hub of the world, right? Everyone's like using these centralized kitchens, centralized logistics centers. So the kind of startups that can thrive here are all the kind of modern ride sharing, centralized kitchen, delivery, logistics, AI-based companies that are the companies that we all want to invest in. Why? Because they can achieve scale. Right? Whenever we're given something, it's a small kind of company. As investors, we always think, you know what? It's kind of a small company. It doesn't have that 100 million, $1 billion market possibility. But a lot of these logistics companies, AI companies, data companies, these companies do have that $100 million market pop that they can grab as a share. So I think this place has lots of examples of potential success. Of course, they have to fight it out, and you have to get to the winners. You asked me how our system finds winners, by the way. We have a thing called the Hatcher Score, which we've been developing continuously for 9 years. We recently, I'm going to show you this during our keynote, I'm going to share with you some research that we've not shared before on this. And what we do is we test any new company against a database of 700,000 companies that are out there, and we look at what is trending and what the capabilities of the CEO are, and what's happening at the company, and what the market size is, and all these different things. We have 75 different AI-based models that we apply to figuring out, is this company investable or not? So we can use AI to figure out what's going on inside these companies. And we've just licensed this to 2 massive ecosystems, one that begins with soft and the other begins with micro. So those 2 groups are starting to use our AI to screen deals now. And to pilot the use of AI to screen deals, which is really exciting. So you're going to see a lot more of this kind of innovation happening where we don't just have to rely on our own human biases anymore. We can rely on the AI to figure out what's trending, what's good, that's out there. And I'll tell a couple of stories about this during my keynote, but there's some surprising things the AI is capable of finding that blew me away as a human.
Very excited for that keynote. Steve, I have a follow-on question for you. What, as per you, is the single most disruptive trend right now that is forcing, and the word forcing, LPs and GPs to really rethink their traditional investment strategies? And maybe how it also applies to the region, if you wanted to add that in.
I don't know if I can say how it applies to the region. I think the most interesting force that I've sort of observed in Australia is the later stage VCs that have actually previously invested into companies during that sort of 2017 to 22 run that have basically pumped in tens to hundreds of $1 million into startups. They're really struggling. They're struggling to get exits. They're struggling with their companies not actually moving towards sort of more utilizing AI across their company. And I think right now you've got companies that are effectively at two different speeds, where companies that were able to easily raise money in 2022 and 2023 have effectively not made the adjustments and basically, let's be blunt, scaled back their workforce and then leveraged AI across their business. And so you're seeing that, and also I'm also seeing that in PE as well. So the biggest difference that I've seen, it's really obvious. You can see that when companies have either been forced to utilize AI across it or have not, there's a big there's two different speeds that the companies are going at.
I can maybe add to that from a regional VC's perspective, because I deal with the private funds here quite a bit. What you're doing, or you're successfully doing, I think a lot of VCs here in the region, or even private equity players, they're trying to embed AI into their due diligence phase at the very least, as you are. How successful they are or not, only time will tell, but definitely an adoption for AI in their investment, during the investment due diligence phase. The other trend that maybe regionally that pops up is there is an enhanced governance need that's popped up here as well for the sovereigns that are funding into the VC space. Historically, it wasn't really something that involved greater governance play. Like the sovereigns would put in money, the reporting would go out as it would. Now there is a huge need for VCs to have really strong internal regulatory like processes and just governance processes in place to attract the institutional capital.
Yeah, you're so right. We're just talking about this over breakfast. I don't know if many people here are aware, but many countries in the world are either getting ready to pass or have already passed data sovereignty policies. What does that mean? It means that if I do KYC on one of you guys as an investor and you're sitting in South Korea right now, that data has to stay in South Korea. I'm not allowed to store that outside of there or I face huge fines. And so I can access it securely for 15 minutes, to check on that data and whatnot. But this is now going to start to apply, my reading of the policies, this is going to apply to data. Your entire data bank is going to be sitting inside the UAE, accessible only by secure sessions outside. What this means is, and I'm not sure the legislators are completely clued in on this, is it means massive data centers that need to be created inside the countries under the control of the government. But then you need governance technologies that can reach out and create a framework of understanding what's going on between all these data centers you can only access securely. By the way, that this is something that very few of the KYC vendors that we work with, and we have 160 apps on our platform, about 5 of those are specialty KYC apps. One of them is compliant right now with this data sovereignty law. So this is something that's coming down the pike really, really fast, and not many people are aware of it. So you're absolutely correct. The governance side of this also needs to become AI-driven and also needs to become intelligent.
Okay, I'm also conscious of time, so I want to move towards move our focus towards the actual sectors or the companies themselves that private markets are now investing into. The UAE obviously has become somewhat of a magnet for innovation, focusing on AI. We brought this up so many times now, but fintech and sustainability plays are also very, very top of mind for private markets here. So, and we're also seeing lots of founders who are moving into the region and VCs apparently as well. So recently, as for everyone ideally in this room, you guys know this, the co-founder and the CEO of Revolut moved his residence from the UK to the UAE. So John, maybe I start with you. From your perspective, how do you see these sectors, fintech, AI? Maybe we stay clear of AI, we've spoken about this. But fintech and sustainability kind of aligned with the global investment trends. And what are the most promising opportunistic areas that investors should be looking at or will be looking at for the next 3 to 5 years?
Sure. I'll briefly touch on sustainability because we've made a few investments in that space. And one of the investments we made in is with a company called Verdana that Lee is associated with as well. And they're also starting to work here in the region. But the great thing about sustainability here as an investment thesis is the government's going to back this for the next 25, 50, 100 years. They're not going to change their policy on it. Whereas if you make investments in certain other countries I don't need to name, the next government may completely nullify all of those investments that you've just made in decarbonization or carbon credits or whatever you've invested in. So this is a great region to invest in sustainability because the Saudi Arabia, I think, is the second leading investor now in sustainable technologies in the world. The UAE is also got a huge amount of investment going on there. These are two very sunny places, so they're very good places for renewable energy that don't face the challenges in other parts of the world. It's very cheap here to build the kind of renewable energy infrastructures that you need. So sustainability is a great theme. The second, and we will stop beating AI to death. Fintech is I was chairman of a payments company here. We had a pretty decent exit. It was called Teller a few years back. And this was the first and leading merchant payment system. And what we saw was this massive rise in merchants while we were building out Teller from a few tens of merchants to thousands of merchants on the platform when we finally sold it. And it's a very successful company, but our partner at the time was Network International, another very successful fintech company based out of here. And so you can look around the region here and you can see neobanks, you can see crypto, you can see all of these fintech companies, including some of the Web3 companies doing very, very interesting things with the full support of the government. Most of the time here, when you're asked to invest in a crypto company, they're based somewhere. You go, is it legal where you are to do what you're doing? And they kind of go, well, it's kind of going to be legal at some point. You don't have that problem here. You can invest with full knowledge that the policy is supporting you in these sustainability investments and in these fintech investments. So I'd say that these are two very robust, very good areas. I can speak from personal experience. We've done very well in both the fintech and the sustainability areas.
So my other favorite sector, I sort of touched on a little bit, but I think one of the biggest opportunities over the next decade is actually going to be in the life sciences and medical device area. If you look at life science and medical device, the actual biggest challenge is how much money is required to figure out basically where they get, when they actually go into the clinic and actually start doing trials, where effectively now, for whether it be drug discovery, drug design, trial design, all those areas now become a lot easier for a lot of the life science companies. They need smaller teams to do it. They can process a lot more data than what they did before, and they can be a lot more accurate with their discoveries. Even more than that, what's exciting is they can even potentially have more different multiple drugs which they could also potentially run at the same time. So, and the really interesting thing about when the new US administration come in, all of them were scared about what RFK would do. And the funniest part is now they're complementary, because one of the first things they try to do is they're trying to streamline the regulatory process as companies go through their different sort of trial phases. So, and that's in both humans and also for pet, for sort of pet companion sort of products. So to me, that's probably, and we're fortunate enough, we've just, done a deal with MTP Connect, which is our industry life science accelerator. I think that's, and Australia is world class when it comes to life science research and also drug trials. So that's probably, for me, a sector which I think has a lot of opportunity for investors, which previously they would have avoided because it's not as sexy as, the high growth sort of SaaS company. But when life science companies win, they win big.
Actually, I've got a giant tip for you in that area. We invested in a company that builds organoids. What is an organoid? An organoid is a tiny little version of a lung or a heart or a brain or something based on human tissue. And it is, if you test any kind of medicine on animals, it's only 10% efficient, the output. So literally millions of animals die completely needlessly every year, which annoys me as an animal lover. These organoids replace the use of animal testing with human tissue testing, which is so much more effective. It's 10x more effective than testing on animals. And the time to market is then years less. So the gift, we all hate COVID because of the horrible time when we had to all wear these masks, but the gift that COVID gave us is it accelerated the pace of approvals for clinical trials magnificently. So now we're in a situation where instead of 5 or 7 year trials, we're now down to 2 or 3 trials because people realized that the last period was very, very inefficient. You combine that with organoids technologies like the one that we just invested in, this is going to create massive new products and accelerated entry into massive new markets for medicine. So I agree with you. I think healthcare is absolutely worth watching as well.
I was going to say, funny enough, our latest company that we worked with that become a unicorn, we worked with them when they were a seed company coming out of Monash University. They just hit the $1 billion mark, I think it was last week or 2 weeks ago, and they're a 4-dimensional lung imaging technology company. There's another one that we work with called EBR Systems, which is also ASX listed. Andrews actually lives in Dubai. Their company, we've worked with them since they were 130 million market cap. They're now up to about 700 million. They just had their US approvals, their sort of FDA approvals for basically the next part for them is the reimbursements from the insurance companies, and that company is very likely to be our next unit. And all it is instead of a pacemaker, it's a wireless pacemaker. So it's a tiny sort of implement that they put into the heart. So everything's getting smaller, easier to insert, and once again, highly scalable.
I'm very excited to follow the journey of that company, well, both the companies, to be honest. I have one last segment, and I want to turn the focus towards the institutional investors or the LPs in itself, and really open question to whoever wants to go first. But when it comes to family offices or institutional investors, when they're considering engaging with the venture capital ecosystem here and or making investments into the private markets here, what makes this region, this market in the UAE, the MENA region, that much attractive to LPs right now, as per you?
Oh, I think it's really obvious. If you're I go to family office events around the world. Last year I was in Guatemala, I was in the US and several places. I was in Africa, I was in Europe. So I've met with family offices everywhere. What distinguishes the opportunities here is you can directly get involved with founders here without having to push 100 VCs out of the way to get to a deal, which is fantastic. It's going to be different 5 or 10 years from now, so make the most of it. Get into the opportunities that are in front of you right now. Why? Because this is the key growth period right now, but also you can get access to those things. In Singapore right now, there are 150 venture firms that can write a Series A check. 150. In Jakarta, like 15 years ago, there used to be 10, and now I think there's 50 or 60 in Indonesia. And so now, as a family office, you're facing massive competition to get into these deals. Here, there's still relatively, the ecosystem here is growing quite fast, but there's still only really a handful of real VCs. So the opportunity for direct investments for family offices and for institutions here is phenomenal. So take advantage of that while you can. Invest while there's this less competition and while we're still at the start of this massive growth cycle.
I'll go a slightly different angle. Obviously, I deal with a lot of international companies. The thing I would love to see for the international companies that come to this region, I think there's a great opportunity to invest and then also add strategic value. Often we see companies, where they just raising capital is one part, but I think there's often networks that you would have, that the LPs would have, the GPs would have, or if it's a strategic investment from a family going into, or even a CVC, they can add significant value to that company in this region. So you can effectively invest into companies at lower valuations than what you'd get if it was let's say, for example, a US startup, but then add effectively your networks, your skill, your experience to actually amplify their success of that business in this region. So effectively, you can manufacture value in the companies that you invest into just by your sheer networks actually in this area. So the role that you can play with, I think, international companies coming into this is they all want to be here. And also, obviously, Dubai Chambers wants them to set up businesses here. And I think those two forces align quite well.
Very, very well put. And I think we're at time, unfortunately, or I could sit here asking them questions all day long. But John, Steve, thank you very much. And guys, can we have a round of applause for the two of them? Thank you.
We thank them for their invaluable expertise, and it's very clear that there are exciting opportunities ahead. So now as we go forward, we're going to go into our first block of company presentations. So this is your chance to hear from the innovators themselves, the people that are turning visions into reality. So each company will have 8 minutes to present to you. And first off, we start with Intelligen SA. They're pioneering new frontiers in delivering clean, fuel-flexible, on-demand power, driving global energy transition. So please welcome their CEO, Peter Stoyanov.
My name is Peter Stoyanov. I am not the CEO of Intelligen, but I'd like to warmly welcome Sam Cockerell, the CEO of Intelligen SA.
Well, good morning. Thank you so much. I am Sam Cockerell. I'm co-founder of Intelligen Saudi and chief executive of Intelligen Group. Now, humanity is about to enter a period of abundance powered by clean, renewable electricity. By 2050, global electricity use will double, powering data centers, electric vehicles, communications, air conditioning, heating, and so much more, from agriculture, mining, and manufacturing to logistics, services, and of course, AI. Every industry, every human interaction, every basic human need will benefit from this electrified future. Solar and wind will provide most of the additional power that's needed. But even with the buffer of battery storage, intermittent renewables present a huge challenge for grid stability and 24/7 availability. Distributed generation from fuels has become an essential complement to solar, wind, and batteries, faster to roll out than grid connections, and reliably matching electricity supply and demand at point of use. Around 200 million internal combustion engines are made each year, serving distributed power generation and powertrain applications, but these are inefficient. They produce harmful emissions, and they're locked to a single fuel when they leave the factory, even though the fuel's landscape will continue to change over their lifetime. Linear generators are a new type of electrical power generator that combines the efficiency and low emissions of fuel cells with the durability and power density of conventional engines. Intelligen is a modular linear generator solution developed in the UK and applied on multiple development programs in the US, Europe, and Asia, where it's protected by over 40 national phase patents. Intelligen Saudi is a joint venture between the UK technology licensor Intelligen Group and our manufacturing and commercialization partners in Saudi Arabia. Linear generators offer a unique software-defined compression ratio, providing the flexibility to run on a wide range of fuels and blends, including hydrogen, e-fuels, biofuels, waste gases, and conventional fuels, without the harmful emissions or costly aftertreatment of conventional engines. Linear generator modules produced by Intelligen Saudi are expected to offer more than 10 times the power density at less than a tenth of the cost of the only established competitor, a US linear generator business that's raised in excess of $800 million. This is because of Intelligen's higher power density, lower cost manufacturing methods, modular construction, and global supply chain partnerships, which provide a unique path to high volume production at cost parity with conventional gas engine generators. Intelligen is the result of over 15 years of development and over $20 million of equity investment and grant funding alongside millions of dollars of customer-led development program revenues. Multiple phases of combustion testing have been completed with Marla Powertrain in the UK since 2021, confirming that Intelligent's powerful electrical machines and precise motion control can deliver software-defined compression ratio in a fully balanced opposed free piston format for extreme efficiency and fuel flexibility. Intelligent has been designed from the ground up to use low-cost manufacturing, component manufacturing methods. Even our first-generation research engine systems make use of low-cost extrusions, paving the way for more extensive use of Saudi-made extrusions in our commercial products. Intelligent Saudi will serve OEM customers in the package generator, marine and automotive industries. The global addressable market for generator sets, auxiliary power units and range extenders in these applications alone is worth well over $100 billion, growing 5 to 8% annually. Intelligent Saudi will have exclusive rights to make and sell products using Intelligent technology across GCC, Africa, Australia and New Zealand, and so Intelligent Saudi has the flexibility to either manufacture modules in-house or to license manufacture to local partners in these regions to quickly gain market share. Elsewhere, Intelligent Saudi will sell modules on a non-exclusive basis, benefiting from Saudi's low energy costs, ideal for the high aluminium content of Intelligent modules. From start of production, Intelligent module costs are expected to be less than other linear generators and well below the equivalent module cost of fuel cells. Early adopter customers will be able to provide power as a service at a lower cost than other distributed generation options, thanks to Intelligent's high efficiency. From this initial market entry position, significant unit cost reductions are expected via manufacturing investment as sales volume build, taking advantage of Intelligent's highly scalable and low-cost component manufacturing methods and automotive design philosophy. Intelligent Group has generated over $3 million of customer revenues in the past 5 years, and Intelligent Saudi is projecting revenues well in excess of this in the next 2. From 2026, Intelligent Saudi will make, sell, and support high-value research engines for leading universities in Saudi Arabia and across the GCC region. We'll sell pilot program developments to help customers evaluate Intelligent in their own real-world applications ahead of series production from 2028 to 2030. Now, back in 2022, Intelligent's UK technology development and pilot engineering business, Libertine, signed an MOU with Ashok Leyland, and in 2023, we completed the first-of-a-kind pilot integration of our proprietary e-machine and control technology into Hyliion's Carnot generator that was first demonstrated in a hybrid powertrain application. In 2024, we received a letter of intent from Sanam Automobiles to localize Intelligent Saudi in the kingdom, forming an integral part of Sanam's future supply chain for electrified powertrains. And so in 2025, Intelligent Saudi was formed. And the team in Jubail and Riyadh has already built an impressive business development pipeline of research engine and pilot customers across the GCC and Africa regions. Intelligent Saudi has a world-class and well-connected leadership team. My co-founder, Mr. Solomon Naldosh, leads our strategy and policy engagement, having previously contributed to national hydrogen and localization policies within the Saudi Ministry of Energy and Ministry of Investment, and leading strategy and sustainability projects at Sanam Automotive and PwC. Dr. Peter Stojanov, our communications and marketing advisor, draws on a career in the mobility and energy sectors, supercharging deep tech innovation with effective market communications for leading players, including BMW and Emirates Group. George Eitelhuber is our product development and validation lead. As founder of Nomad, he's overseen the full product development journey from prototype to commercial deployment of advanced technology operating under extreme environmental conditions. And so we're now seeking $500,000 of pre-seed funding to strengthen our executive team, build our initial operations at Sanam's R&D center in Jubail as we close our first wave of customer research engine and pilot project sales and secure incentive support funding. These milestones will ready us for a further $5 million of seed equity funding in 2026 alongside government incentive funding as we prepare to scale our operations. This is an opportunity to invest early in a clean power manufacturing business set to become a world leader in the linear generator category. Saudi-made, globally scalable, Intelligent is positioned to power the world's energy transition. Thank you.
Thank you so much, Intelligent, for that wonderful and fantastic start. So as we move on to our next company presentation, we have Intellecta Education, a company that is poised to disrupt the rapidly growing edtech market. So please welcome their founder and CEO, Merrick Russell.
Good morning. My name is Merrick Russell. I'm Australian. I started a company in India for the Indian education market. We intend to develop AI learning tools, particularly for Indian, and then move on to GCC companies as well. That's my button there. We are passionate about education and the opportunities it brings to students who are able to seize opportunities, and we want to put the best tools into hands of not just the wealthy, but also capable and even struggling schools within India. It's a very large market, as you can imagine, as well. And my team is, we've put together over the last several years an exciting team, local CFO, technical experts. We're based in Bangalore. Our whole team is Indian, apart from me, pretty much. And we have strategic advisors as well as marketing experts ready to take bring the next best AI produced educational products to market. And that market is huge. In India, there are 250 million school students K-12. We're going to be targeting year 5 to year 12. And we're expecting even as much as 169 million in year on year by year 5. We have a letter of intent with a school group that represents 100,000 schools. That is a significant school group that we have significant inroads with. We expect to be able to reach 18% of our obtainable market by year 5. I've been going to India for over 5 years, and I've seen some amazing things. I know that when it comes to education in India, there's clothing, there's food, there's breathing air, and there's education. It is one of the most fundamental desires for parents to have for their students. Schools and parents seek digital learning solutions that identify and will fill knowledge gaps. School classes in India can be as many as 60 students. That's not the kind of experience I had at school, where I could put up my hand and ask the teacher a question, or they could see the frowned look on my face and understand that I didn't know something. When there's a classroom of 60 students, there's much less opportunity for proper interaction, what we would consider good educational outcomes, and therefore also limited feedback, which is the gold standard of good education. The class sizes, the quality of the content, and limited resources mean that educational outcomes suffer. This happens all over the world. In India, I think it's even more profound. The result is rote learning. If you're a teacher, that's what you default to. Limited feedback, limited progress tracking, student disengagement. And if your delivery style is uncreative, then what the students do is also uncreative, and which is what we want to break away from. And it's also can tend to be impersonal as well. Our AI learning system is going to enable students to fill those knowledge gaps and get quality feedback, providing access to students who may not have access to the full content. In India, there's 32 million students or children who don't even go to school. I want to stimulate curiosity in the presentation style of the content. We can provide rapid feedback. That means if a student asks a question and there's some knowledge gaps or they get it wrong, they find out immediately. And that is the gold standard for good education. I used to be a teacher, didn't get that. Engagement is really important as well, but it's probably a little bit misused these days. Engagement, I think up till now, has been defined as how long a student looks at a screen. Let's do a whole lot better than that. I define engagement in terms of quality education outcomes. With AI, we can develop personalized learning paths, and we can track progress as well, not just for the student, but for the teacher and parents as well. The key features of our AI learning system, that we have a defined learning, defined language model, which means it's not a large language model. We're going to target the local CBSE and ICSE curricula. That means that we'll be able to bring interactions back onto course. It's not going to be a large language model. We can engage in multimodal style kinds of engagement. So if you're learning something, it's important that you engage with that content in many, many ways, not just listening. It's safe, it's responsive, and we're going to look at well-being as much as anything else as well, because we know that there's a lot of pressures on students, and we want to be able to help them in their social development as well. And it's going to be for parents and teachers. I just want to look at this responsive part. The AI prompts the learner. It's not us prompting the AI. So in terms of proficiency and efficiency tool, AI has really come into its own. But in education, we want to do something more. We don't want a proficiency and efficiency tool. We want a tool which is going to help students engage with the content. And for that, we need more than a generative AI where the user prompts the AI and the AI will give a response. As efficient as that may be, it's not what education is necessarily about. What we want to do is a kind of agentive AI, edugentive AI, where we can have a mentor, an AI mentor, which will get to know the student, know the weaknesses. It will know the student's timetable. It will ask the questions of the student and find out their weaknesses. It will understand their development. It will also know their interests and their strengths. And with that sort of information, we can also give career advice. Right now, it's very hard for students to understand exactly what their options are. With our AI tool, which is edugentive, we'll be able to give them proper advice. And as soon as we start thinking along this way, the possibilities, the functionalities that we can build in are profound. Our obtainable market is $940 million US. We're B2C, so we'll be subscription-based, but also B2B. We're targeting grades 5 to 12 with $169 million revenue year on year in year 5. We seek $3.25 million in funding. We do have a phase 2 and phase 3 rounds of products, which I just touch on just at the moment. We've got a proof of concept of the full K-12 curriculum in the CBSE curriculum, which is the most popular English spoken curriculum in India. And that alone will generate $135 million year on year in year 5. It is highly graphic, which is very, very important for quality engagement, especially in the Indian market. We also have a phase 3 skills offering. The National Education Policy in India mandates a skills offering, and we have that already developed. It's been market tested in Australia, and it's best practice STEM education, which we're very excited about. It will involve manufacturing. There's our timeline. I'll just move on. No other offering really matches our quality of content, the quality of delivery, the educational outcomes, and the AI functionality of our product. It's a very interesting moment in time. There is a cultural readiness. Students are comfortable with digital learning. There's exceptional demand in India. There's parental premium placed on educational enhancement products. Government policy is in place for this. They're very excited about AI potential in an Indian market. The technology has matured. AI has moved on from just chat and generative. This is the next thing. We want to take that first mover advantage. And there's burgeoning use of digital devices in India. 80% of the youth have a digital device. This is me. I'm an ex-teacher. I'm also a product designer. My name's Merrick Russell. I love bringing product to market. Thank you very much.
Thank you so much, Merrick, for that very insightful presentation. What an exciting conference we still have to go. So with our next company, I would like to welcome, please, for the ID'd Pty Limited. They are transforming compliance with their ARC platform for secure, verified workflows. So please welcome their founder and CEO, Justin Amos.
Thank you for that nice intro. My name's Justin Amos. I live in Sydney in Australia. Been flying around for the last few days. hence the deep voice, so apologies for that. So I'm here to talk a little bit about what we do. We do quite a lot. We've been in the market for nearly 4 years now. 2 years as ID'd, and we've built a digital platform for commerce. The main kind of thread as to why we're excited about being in business is that our ARC platform, which has digitized bank guarantees in its first instance, happens to come with a compliance tool. We've done a JV with AMP Bank, or an SPV with AMP Bank rather, that's allowed us to, they outsource the entire product line of bank guarantees to us. And we built an AML CTF reliant platform for that. So we actually have to do onboarding as though we were a bank. Now, the big shift in everything is, I'm sure you're all familiar with FATFA, so the Financial Action Task Force. 10 years ago, they arrived in Australia, did a review, told the Australian government that they're not quite up to scratch and that they would give them 10 years to change the AML and CTF regime. 2 years ago, the acts got passed through Parliament and the bills, and the regulator, Australia, was given 2 years to implement it. That's happening now. Okay, so currently in Australia, you've got 15,000 businesses that are supposed to do AML and CTF research on all their customers. The new regime is going to make that nearly 100,000. So that's 85,000 businesses that have, with a hard deadline, that needs to come up with a method of doing due diligence on their customers to a standard as and the framework that's been provided by the regulators, and also have the compliance resources to be able to execute on their policies. Okay, that's just not going to happen. They're not going to be able to get it done. So the widening of the net has created a unique opportunity in Australia for people to step into this space. Even the regulated entities today, the 15,000, the actual role, what they have to do, isn't been expanded. So they're all going back to the drawing board. And if you can provide a technology service that does both the AML and CTF and verified parties on your platform, you're going to be in a pretty good place to take advantage of this opportunity. Okay, so this has happened before. It happened in New Zealand in 2013 and 2016, created chaos, largely for legal firms and conveyancers who had to turn this around. They still had a couple of years to do it, but obviously people leave these things late in the day, and then found out that they couldn't actually get up to the standard required. So Sydney-based top 5 law firm globally actually dragged us in because it's like top of their agenda for their C-suite on how can they satisfy this new requirement when they're a law firm. They're not a technology company yet, and they're not really a compliance firm. So they're looking outside, well, how can we actually get this done? Same with the local lead commercial law partner that works with us was talking about how that actually impacted the business in New Zealand because they weren't ready and they weren't able to transition and bring customers onto their books so they can then provide them with legal services and charge them for those services. So as we can see, there is a big driver coming from the market to actually accept this. And there's a very important statistic on there. Of the current firms that are required to do AML and CTF surveillance, 56% of them outsource it to a third party. So you can extrapolate that out and go, well, okay, of the next 85,000 that are coming up into this net, how many of those are going to look for third parties to do this? And they can start to sort of build up a business idea and you go, well, why wouldn't you be involved in this if you're currently doing it? Okay. From a competition perspective, there's quite a few global firms that actually provide software that allows you to do AML and CTF and customer due diligence, KYB, KYC, etc. But there's very few firms that actually offer both the technology and the compliance resources to digitally onboard customers for their businesses. So you probably will get access to these presentations. So just put the details up there for everybody. We feel pretty punchy that we've got the right tech and the right opportunity, and we're in market already. So in terms of size, net new spend on compliance services is getting close to 3 billion Australian dollars. All right, when we look at like where we think we have the right to play in this market, we think the revenue that we should be targeting should be somewhere up to $171 million. I'll take 1% of that, right, in the first instance, and then you kind of grow on that. So on this slide, if you want to read it, I'll just pause for a second, where we've identified the existing firms and industries that are regulated and the new ones. So real estate, lawyers, conveyancers, accountants, auditors, trust codes, gems and precious metals, they all have to come in. And you can just think about all those businesses, right, that are looking at this and looking at the frameworks. You know, like, how are we going to stretch to that? How is that going to impact the real estate industry significantly? So they're all scratching around trying to find a way forward. Oh, sorry. There's a little slide on the founders. I'm not the only founder, co-founder. Simon, Jason, and I, we've worked together for on and off, not consistently, for over 20 years. We've already had one successful exit. I've spent most of my career at JP Morgan doing algo trading technology and fixed connectivity and all things like that. And we kind of like branched out. We've already gone through the blockchain ramp up in the adoption of the blockchain. We've done quite a lot of work in there. I was head of emerging technology at PwC in Sydney. So we've been together and we've done a successful exit, and we've really stuck a boots in the ground on this one. We have a small team of engineers, all onshore, going back to the use of AI, responsibly, of course. So we've got a little bit of blockchain in our stuff, a little bit of AI in our stuff, but we don't talk about it that much because we just don't think it's that relevant, to be honest. So from an ASP perspective, we have got our board has approved a 2 million Aussie dollar raise. We did a small raise earlier on, just before the end of June, because we're an ESIC company, which comes with tax advantages in Australia for Australian investors or Australian taxpayers. So it might not apply to everybody that little bit. And we're looking to get that done before the end of the year. That spend is largely going to be going on the marketing and go-to-market and getting those customers signed up, because when people finish their Christmas holidays, in Australia, that's generally like the end of January, they're going to be like running really hard at this. So if you're well positioned and you're in market and you've got the right tech at the right time, you're going to have a good chance of getting some of that market share. And we think we're in a pretty good spot to do that. Just some more details in the pack for the New Zealand case study. Okay.
Thank you so much, Justin, for that fantastic overview. Now, as we move to close our first pitch session, we welcome a company, Zaindu, a company that boosts farm yields boosts farm yields 17% with patented cold plasma activated air systems. So please give a warm welcome to their CEO, Ralph Weir.
Good morning, everybody. I'm Ralph Weir, CEO of Zaindu, transforming agricultural performance using cold plasma. This isn't AI. This is something much more important. This is about agriculture, the fundamental thing that keeps humanity going. It's worth about $6.5 trillion a year. This is just on the crop side, not the animal side. And look at what the farmers are facing. They need a huge asset base. They've got very high input costs. They are fighting in a world where chemicals are becoming outlawed and banned. Very tough to make money. They're working on very, very thin margins. So is there anything that we can do to really help here? Of course there is. We use cold plasma to improve the performance of their crops. That's the effect of applying cold plasma to seeds before they're planted. You can see the before and after there. That's grown in one of the UK's top herb growing greenhouses. and the impact is phenomenal. 10 to 20% more produce, a massive boost in their productivity and therefore in their profitability. The way it works, you pour seeds into a drum for treatment before you plant them, put the drum on the machine, select a recipe. We have something like 250 recipes for different varieties of seeds now. We've had the first mover advantage in this space, so we're well ahead in that regard. What it's actually doing is priming the seeds, giving a lot more performance, releasing the inner performance of the seeds. We're doing that by encapsulating years of agronomy experience, of the experience of the growers. We're encapsulating it into software modules that are downloaded onto the machine that we just looked at. That brings the boost in production yield, but it also brings flexibility in the supply chain. A farmer can now go and buy seeds from many additional sources, knowing that they're going to get top drawer performance. We call the system activated air. A lot of people are starting to talk about it, so it's probably time for a quick case study from one of our customers. 80 Acres is one of the most advanced and largest growers of salad in the US. They sell something like $200 million of salad leaf every year. Megan is their head grower. They became a customer about a year ago. Let's hear what she has to say about the system.
So for any grower that's thinking about using activated air, it's what are the crops that I can apply this to? What is the potential yield benefit that I can get just from increased germination rates? What is the potential yield benefit I can get from increased growth rate? And those numbers translate into dollars.
So turns into dollars. I don't think we could have said that better ourselves. Megan became a customer about a year ago with a single system. They now have 3 deployed across multiple farms. We expect over the next 6 to 12 months that number should increase to somewhere between 12 and 15 systems. So obviously a company that has seen the technology, seen the potential of it, completely bought in. Business model is actually, although there's a hardware element, it's a SaaS type of model. It's those software modules that we're downloading. We're looking at lifetime value in contracts of about £600,000 and a very, very high profit margin on the hardware, if you look at it from that perspective. The rollout plan is incredibly simple. Initially, we're focused on leafy greens, the salads that people like 80 Acres are growing, rolling in tomatoes, and then moving out into the fields from the sort of greenhouse and indoor grown environment. The size of the market overall is absolutely enormous, something like $6.5 trillion. If we could take a 1% cut of that, imagine what a business we can build here. This is where we're at with building that amazing business. We have 23 installations out there across 19 separate customer sites. There are obviously multiple repeat customers in there, proving that people will come back and buy more of them. And we've been able to support that global capability using a team of 18 out of our base in the UK. What we're doing with this current funding round is scaling our sales capability from this already proven platform. In terms of competition, to be honest, there's not much out there. Cold plasma is a very difficult technology. Combining it with seeds, they say opposites attract, not in this case. It's a very, very difficult thing to control. We have all the patents on how you do it. We think it's the only viable way of doing it. So we're unlikely to see real competition coming out in that space. What we're replacing is traditional methods which usually involve dipping seeds into some sort of chemical, which is probably dangerous. It's probably about to be outlawed. It's introduces a lot of variability into the process, and it doesn't perform in anything like the same league as cold plasma in any case. Very proud of the team that we've got. I mentioned 18 people. There's the management team. We have a real can-do culture, and we're supported with a board that we jokingly refer to as the done-it board combined with a can-do team. So it's a nice combination. You see some of the places that we picked up some of our skills and experience along the way. And a great group of people to be working with. Finances, not much time to talk through that, and it's probably too small to read from the back anyway. Key points, we're investing heavily in the business through next year, moving into cash flow break even in late 27. And by the end of 28, we're looking at a valuation of the business, which should be running at around the $200 million level. A few of our strategic growth initiatives, scaling the sales and commercial activities, introducing more sales channels, bringing in some of those additional crops that I talked about, things like tomatoes, and moving onwards and upwards. There's then some financial points on that. In terms of exit strategy, it's very early to talk about an exit strategy for a business like this. I think as we progress, many opportunities will open up. It's clear that there are many companies out there who want to use the technology, and a group of those are moving forwards who are interested in controlling it, exploiting it, and of course those sorts of words ultimately lead into acquiring it. So I think that will be the ultimate exit strategy, is to go for a trade sale in something like the 3-year time frame. There is obviously a potential to move it on far beyond that. It's a very acquisitive sector traditionally, so there should not be a shortage of opportunities. To pretty much wrap up, we have some top drawer names in our current set of investors. Foresight Group, £13.5 billion worth of assets under management. So they're a sizable player. Oxford Technology also. Yes, and all of these are participating in its current funding round. What we're doing is raising a couple of million to help us scale the sales and the commercial activities. There's 2 of us here today, myself as CEO, and Riaz, who is helping us with sales, particularly in the Gulf region. So if you're interested, please do reach out to us in one of the breaks. Thank you for your time.
Thank you, Ralph. So what an impressive array of innovation we've seen on display this morning. Now, as we go forward, it's my pleasure to welcome back to the floor a familiar face from this morning's session. As the co-founder and managing partner of Hatcher Plus, a top-tier data-driven venture firm, John Sharp is at the forefront of using AI to shape the future of investment. We're thrilled to have him share his deeper insights with us. So please join me as we give a warm welcome back. Thank you very much.
Thanks, everyone. Thanks for sticking around. I promise I'll make it worth your while. Oh, that's not my slide deck, though. By the way, that was a terrific presentation. Definitely very interested to learn more about that. As the son of a farmer in Australia, I found that very intriguing, and certainly something that I'd be personally interested in putting some money in. Yeah, so as you heard, we've been doing this for a little while. We started doing predictive analytics in 2016 when it was deeply unsexy and no one believed it could be done. And so our particular special sauce is that we ended up with a lot of data. And I just see Carter's main representative walking in right now. They've also got a lot of data. I really love reading Peter Walker's insights on our industry. We've used that data initially to invest ourselves, and then we actually started licensing it to other folks. And we now have a couple of very large global companies that are rolling out through their ecosystem and using it to screen deals. We have 700,000 deals in our database, but beyond that, we've actually created 20 billion synthetic VC portfolios. What does that mean? We have built every imaginable type of VC fund you can imagine and compared the portfolio results. And what that gives us is deep insights into what works when you're constructing a portfolio. And up front, I'm going to tell you what works is a portfolio that you build with as many companies as possible that you can invest in at a selection ratio of 1%. These are the 2 critical things that you have to get right. Stage matters also, and you'll see on this graph here, what you can see on the left is our analysis of about 200 venture funds on the left here. And you can see all of that sort of orange-colored stuff. That's 50% of the venture funds that are out there. They don't make money. You're far better off investing in Dubai real estate. When you get into the green color, this is where you're starting to make money. But even there, the first initial ones, you're getting 2x returns, which again is deeply unsexy if your money is locked up for 10 years. So what everyone's looking for is the top quartile return that you only get from the top quartile VCs that are going to give you that 3 to 4x return. So how do you get it? The graph provides a clue, and the middle graph is a different extrapolation of that. In fact, let's move to the middle graph. That middle graph looks very complex, but it's actually very simple. What it says is if you invest in 1,400 companies in your portfolio and you invest super early stage, you'll make 5 to 6x returns. Right? How simple is that? Pretty simple. If you invest in 10 companies and you invest super late stage, you'll make maybe 15%. That's private equity. Right? So that's the difference. If you want to go after the multiples, you need to go very early and you need to go very wide. That is the core results of our millions of dollars worth of research that I'm sharing with you now. You don't have to spend the millions of dollars. You just have to adopt that strategy. You'll be absolutely fine. And one of the reasons for that, on the right-hand side here, you can see the other results of our research. What you're seeing there is investment at friends and family round, pre-seed, seed, Series A, and then the rest. Now, what's super interesting about that, this is your return on exit as a multiple of invested capital, MOIC, which is the most popular metric that we use in venture capital. So the multiple on invested capital is significantly better. Even after all of the dilution and everything else that happens along the way, you're still better off to invest super early stage. People don't do this because it's super risky. Super risky. It's not done yet. I need traction. I need to see recurring revenue. Well, yeah, now you're in Series A or even possibly Series B territory. So if you really believe in something, try and get into it as early as you can or get a discount and get in there faster. Okay, so what does our AI do? It's actually 75 models that we've created over the last 10 years. My partner, Dan Hookturp, deserves all the credit for this. Dan had a couple of $1 billion exit with a company called Bankrate. That he built with Tom Evans and a few other guys. It's a really successful fintech company that was at one point the 10th most trafficked website in the world. Dan's built our AI models and he's built them superbly. And what these models are able to do is predict future valuation. I'm going to get into that in a second, and also give you some feedback as to what the portfolio should look like. If anyone's interested, and I see some people taking video and pictures of the slides, you can just DM me later. John@hatcher.com works. And I'm happy to send you this presentation. So we did this study and we figured out that we wanted to invest in 500 companies at a 1% selection ratio. Can anyone tell me how many deals you're looking at? 50,000, right? So how do you look at 50,000 deals using AI models and then handle all that information? So we had to build really ridiculously clever robotic process automation systems to handle all this stuff. That's what you're seeing in front of you here. So our back-end operating system, which we call the FAST system, Funds as a Service system, is fairly unique. It combines about 160 applications and enables us to understand what's going on, automate due diligence, automate all the fund admin inputs and everything else we need to manage the process. Our track record's pretty good. We've done over 400 investments. The first fund's done brilliantly. Second fund, the second cohort, the post-COVID cohort, because we had a pause, is sitting now as it's in the top 3% of VC funds globally in terms of performance, which we're very thrilled about. All right, so let's get on to the meat and potatoes. What we're doing here is we're actually building the first quantitative VC fund with this technology. And here's how we're doing it. Every time someone applies for funding, we generate a Hatcher score. And apologies if this sounds a bit like an advertisement. It's called a Hatcher score, so I can't sort of get around that. The Hatcher score is a score out of 1,000. And so in this instance here, there's a 765 score. For those of you familiar with the US FICO system, 650 means you get a mortgage, 750 means you get a mortgage at a better rate. Our system is quite similar. Below 650, it's very hard for us to invest in that opportunity. Above 650, going from 650 to 750, 750 to 850, what we're able to do then is think about quantitatively weighting our allocation to a company. It's never been done before. That's why we're calling it a quant VC fund. And so we tested this. We didn't test it with 40 companies or 400 companies. We tested it with 40,000 companies over 2 years. And what we're able to do is accurately put these companies into 3 buckets. We'll go up in value, we'll maintain value, we'll go down in value. Now, 2 years ago, we weren't sure if this would work, so we didn't pay a whole lot of attention to it, to be honest. It was just an experiment that we did. And then we went back after 2 years, and not only did it worked amazingly well. The top tier ended up being about 1.5x, the mid-tier about 0.9x, the bottom tier 0.28x. Now, that's a first. No one's ever predicted valuations for a cohort before going 2 years into the future, and we managed to do that. The methodology, lots of small type. I'm not going to go into it here, but it was very robust methodology. We didn't want to mess around, and we wanted to use a lot of data. This is what some of the actual outputs look like. We predicted funding, follow-on funding, and exits, and we predicted that with a very, very high rate of success. So what this means is we're able to determine whether a group of companies would exit and whether they would get follow-on funding or not. There's a term in data science called lift, where you look to see how well your model's outperforming just a random assessment of how, or a baseline of how that model should perform. Our lift, in this case, we were able to predict funding, follow-on funding and exits with up to a 10x level of lift, which was pretty unheard of. We also saw this in our H2 fund, so we got to use this with our own live data, and we saw almost exactly the same results, which is pretty amazing. So why is this important? All of you guys in this room, I assume, are either founders or you're allocating money to venture capital investments. And the way that's typically been done is the team comes and presents, and you think this is a pretty looking team. This is a great presentation like the one that we just saw. Yeah, I like the story, I like the team, and that's how you invest. Upstairs from that, the funds have much less differentiation. Yes, it's a pretty looking team, but their IQ range is the same as the guys that you saw yesterday. All right, so that team's walking in with a track record and a team that's got a pretty smart bunch of guys that's connected to deal flow and connected to everyone that they need to create value, but very hard to differentiate that as a fund that you can invest in. So for the first time, what we can offer allocators is a science-based approach. So you can actually deliver a strategy that has predictability built into it. And this is a first. It's never happened before. There'll be lots of people like Hatcher that come along in the next few years, and they will have models that they've also spent 9 or 10 years building, and they will make similar claims. But this will be the core of venture investing going forward, whether it's Hatcher or whether it's one of our competitors. This is how people will invest within the next few years, and certainly 5 years from now, this will be the standard. All of us will use some form of machine learning-based data models and algorithms to invest in what is currently a very manual gut feel process will be replaced with a lot more smarts and a lot more science-based algorithmic approaches. So what we're doing here is quantitatively weighted investment. We license the technology to anyone that wants to use it. We'd happily do a deal with Carter or anyone else that wants to take this out into the world. We just did 2 deals with 2 very, very large companies to license this to them. What we keep secret is our proprietary allocation algorithm. So that's what we keep for our own funding purposes. So I'd love to have any of you guys that are in the room interested to learn more. Let's come together and let's build the first quantitative VC fund. It's possible. That the tech is proven. I'm around for the next hour or so, and then I have to go over to DIFC for a meeting, but I'm based here now in Dubai. I'm very happy to say recent Golden Visa recipient and loving living here. So thanks for the warm welcome, and I appreciate you listening to our story. Thank you.
Thank you, John, for that truly insightful address. So now, ladies and gentlemen, it's time to not just nourish our bodies, but also our networks. The doors are officially open for our networking lunch. This is a great opportunity for you to carry on conversations and to make new contacts while also indulging in some delicious food. So we will meet back here promptly in 1 hour for our afternoon sessions. Until then, enjoy your lunch. Okay, so welcome back, everyone. I trust you had a productive lunch. So as we're going forward, we're going to shift our focus to one of the most dynamic and rapidly evolving areas in investment today. So our next panel will explore digital asset and alternative investment trends. So join me as we welcome to the stage our expert panelists. We have Emin Yilmaz Butun, the founder and CEO of Accelerate MEA. And next also please, Alvaro Molina, Ecosystem Manager of New Tribe Capital. Nicholas Payar, the Managing Partner of Liberty Capital Limited.
Thank you very much for joining us today, Nicholas and Alvaro. Today we will be talking about digital assets, digital currencies and alternative assets. But before starting, we already started, but I want to give some background about myself. I have experience in corporate business managing investments in pension funds, also managing large-scale digital transformation, M&A, and all organizational transformation and innovation management in Fortune 100 companies, as well as I managed and built technology companies in the region, including healthcare, insurance, and education tech. And I'm building an innovation tank. Also, I'm part of many NGOs. I'm a strategist. I'm building strategies for large organizations for the future, considering different part of the ecosystem, like politicals, geopolitics, because I studied politics, but I work in finance, investment, and transformation and technology projects as well. So building strategy is very important to understand, need to understand context for each country and each region. So today's discussion will start with digital currencies because the world is going there. I want to start with, before introducing our panelist, IMF Managing Director. She said, world is going from fiat currency to digital currencies. If any country wants to lock themselves and close the relationship or collaboration with the rest of the world, good luck to them. And BlackRock CEO, which he said for the Q3 closing talk on CNBC, he said, we are now moving digitization and tokenization, all kind of assets, not only real estate, but now we are talking about bonds. So any financial assets can be tokenized. So we will start the discussion at that point. Before discussions, I want to do fun announcement. I'm part of Women in AI for the Middle East region, and we are building the Empower Women in AI and Technology business. So if you want to invest an interest in this area, because it's an NGO, this is a non-profit organization, but we are working regional ministries to empower women throughout the region. We are looking for mentors, investors to invest in women in AI, entrepreneurship and technology entrepreneurship. Please reach out to me while we are here. So, Nicholas, would you please introduce yourself?
Thank you, Amin. My name is Nicholas Payar. I'm the managing director of Liberté Capital. We're a 3C fund management company regulated by the DFSA, based in the DIFC. We've been in the UAE for 25 years now, which makes us one of the first in the space, and definitely first in the DIFC. Following the Maktoum family, it's very difficult to come in front of them. I'm personally French. The family office is a third generation French family. And we are usually very steeped in anything we can touch. So it's real estate and it's private equity, but we're trying to learn how to adapt, which is the basis of this panel.
Thank you very much. So, please introduce yourself.
Hello, good afternoon to everybody, and thank you for being here today. My name is Alvaro Molina, and I'm part of New Tribe Capital. We are a Web3 fund, Dubai-based. We are 5 years on the space, which sounds nothing for traditional funds, but in Web3 is like OG almost. We are the second most active funds in terms of Web3 in Middle East after Cypher Capital, which is also hard to beat. Personally, I come from Spain, as you can feel from my British accent. And my background is in genetics and molecular biology, which has been quite a trip from that to Web3.
Thank you very much. So we will start with you today, the questions. So Dubai Wara Virtual Asset Regulatory Authority, established under Law Number 4, 2022, and provides clear regulatory foundation for digital assets, complemented by ADGM and DIFC and other free zones in the Dubai. So our question is coming from the scientific background, because you're coming from scientific background before moving to blockchain. How do you weave Dubai's approach to fostering innovation in the digital asset space? And what makes unique the position to lead in Web3 adoption in this country?
Well, I always say the UAE is right now probably in the best position to lead the change that is happening, for the single reason that everything is established. You have regulations, you have the BARA, you have the FC, you have the NCC, you have RACDAO, you have several different regulatory bodies, each of them covering different aspects of investments. You have also the infrastructure. You have already exchanges operating in the region legally. You have market makers, you have institutions, you have all the bodies that you need to get involved. They are here. Also, physically, it's perfectly located. It's 8 hours away from Europe, Africa, Asia. It's okay, 14 hours for if you are in US or Australia, but still, it will tell you maybe 24 hours if you go to somewhere else from there. So I think all these key points make the UAE like a unique space to foster everything that is regarding Web3, real world assets, investing. So, and this year we are seeing like how to say, everything speed up really quickly. They are definitely trying to win the race, and they are doing it.
Just follow up. I will ask these questions, Nicholas, as well, because I have reported Middle East and Africa. I see digital asset and cryptocurrency trends among the investors. This is institutional investors report for 2025. In Middle East, we are increasing our investment. It's 60%, I can see. On the contrary of rest of the world, they are decreasing. How do you evaluate this in this region? Why investor increasing more in this region for digital assets and cryptocurrencies?
I think one of the beautiful things of the UAE is the evolution that we've managed to see over the last few years. I mean, for an office like ours who's been here for 25 years, we were drawn here by geographical location and tax benefits. And what has happened over time is that we've evolved into a regulatory framework which you can now compare to London, Singapore, or Hong Kong. So you have got the advantage of the geographical location, the tax benefits, the infrastructure, while being in a regulated and recognized jurisdiction. Today, when we travel with DFSA written on the bottom of our business card, we are recognized whether we are in China, whether we are recognized in London, in New York. And you've got a young and nimble organization managed by a dynamic government which wants to be first at everything. And while a lot of countries want to be first at everything, the difference between the UAE and the rest of the world is that when they decide to do something, they actually do it. And when they've decided that we're going to adopt digitalization, tokenization, and blockchain technology as an underlying development for the economy, the momentum, whether it is from the government of Dubai, the ADGM in Abu Dhabi, or the DFSA in Dubai, is to push all of the member companies to do that. We at the DFSA now actually have an ecosystem manager who's been appointed to us to help us evolve within the digital world. And for someone like me who barely knows how to use his iPhone, that poor guy has an uphill job. But we are able to, as a family office, as a fund management, use modern technology now as an underlying enabler for our existing investments. And I think what's interesting is the link between old school families like mine who don't understand technology and the fact that we're able to adopt modern technology, not as alternative investments, but as an underlying technology to make our existing investments more efficient, more transparent, more cost effective, and to democratize them. Because suddenly I'm not selling a 10 million euro fund anymore. I'm selling 1,000 euros to fractionalized investors. And it's usually a lot easier to find a guy with 1,000 euros than one with 10 million.
One comment about Larry Fink for BlackRock's CEO, because he was saying all the assets in the financial world will be tokenized. And in this report, we see the cybersecurity is the most risk for the investors. When considering Dubai is leading 60% in digital asset investments, they are considering, but in North America, I can see 25% and 74% of the investors decreasing. They don't want to invest in this area space because of the cyber risk. How do you evaluate this for the Dubai?
This is for me or Alvaro?
Let's start with Alvaro, and this is for... Okay. Okay. So what do you think? Because 60% investment in digital assets in Dubai we are considering, but the world is going somewhere else. They are not considering because of the cyber risk. How do you evaluate in this region? Are we sure as an investor about the cyber risk, or we are very feeling confident, clear about the regulations, rules, and technologies, safety and security?
Well, you can never be 100% sure. There's no chance, but has been the same with traditional assets. There's always a way to steal, scam, to do something. But at the same time, blockchain, the very nature of blockchain was that, to avoid this. It's a tamper-proof technology when properly done and properly decentralized. I can give a very good example of how the UAE believe this technology is safe. Probably, I don't know, maybe some of you knows, but some maybe don't know. When you arrive into Dubai and you have this biometric at the airport, scanning your face, just to let you know, that's database is not a traditional database, it's a blockchain database. It's decentralized and tamper-proof to avoid any personality modification. So there's no way even somebody from the government can modify. So that's how safe can become. Another example of the government trusting in blockchain is like, how many people here own a property in the UAE or in Dubai? I'm sure you receive now not a paper, you receive a PDF file that you say, my printer, no. Any of you have seen the last line on the DLD, what is written there? I invite you to check your DLD. The bottom line is you do not need to print. It has been tokenized on the blockchain. It's tamper-proof. So this is the extreme that the UI government is trusting, because real assets, real estate assets, is everything for this government. So that's the extreme, how they much trust in the technology.
Okay, that's a great answer, actually. So Nicholas, I want to turn to you about tokenized assets like digital treasuries or real estates are being integrated into family offices strategies as part of long-term diversification efforts supported by Dubai Financial Service Authority and ADGM guidelines. So as managing partner of Dubai Financial Service Authority, regulated multi-family offices, how are your clients approaching digital assets and tokenized investment as part of their broader portfolio strategies for long-term wealth preservation?
So the wealth preservation is the key to your question. At family offices, increasing your wealth is a bonus. Maintaining your wealth is the ultimate mission that we have every day. And what we try to do is to not treat these new technologies as alternative investments, but as underlying technologies to advance our existing wealth preservation strategies. So by utilizing the blockchain, by utilizing tokenization, by utilizing fractionalization of investments, we're able to adapt our existing strategy and our existing products and to make them safer, as Alvaro was explaining, to make them cleaner, to make them more affordable, and as well more cost efficient. Because a lot of these old systems, when you are trying to fractionalize or when you're using paper bonds or things like that, it would take you 6 months to 8 months to a year to create a fund. And unfortunately, sometimes by the time you've created the investment vehicle you want to sell to people, the market's moved on and you've got a legacy product that nobody's interested in. Now, by setting up products through the DIFC or the ADGM, which you can now do on the blockchain technology by digital tokenization rather than traditional fractionalization, you're reducing the setup of a fund from practically a year to maybe a month and a half, which allows you to be relevant, which allows you to be faster on your feet, and which allows you to be able to address the requirements of the market without being behind in 2 economic cycles, in which case usually your product might or might not make sense anymore.
Thank you. Oh, I want to turn back to Alvaro because you're coming from science-backed, and you are combining the systems thinking for blockchain and decentralized finance. The question is Web3 technologies. So these technologies influencing broader sectors such as healthcare, life science, or sustainability. How do you evaluate this?
Well, the use cases of blockchain are really, really wide in health science, to the point that there's a new term, SCFI. It's a whole narrative that we are actually investing in some portfolio companies. From the point of view of databases, from all the research institutions, experiments, one of the biggest challenges in science has been always the not legit data. And it's very hard to verify because you just read a paper. You don't have access to this data. You have to trust or be smart enough to say, there's something fishy here. We want to repeat the experiment. But with blockchain, you will have access to all the data. And every laboratory in the world can just verify it. And nobody can modify a single result. Because you can track all the way to the machines used for measure this data. So I would say in science is one of the biggest use. In healthcare, I think the UAE is also doing some pilot about this, tokenize all your personal information when it comes to health, or your historical medical background, everything that you have been through in your life, in the way that you also will not be able to hide something or to show something. So I'm very sure that insurance companies are going to be very interested on this use case. Maybe not good for us, but they might see that you have done a cancer test 2 years ago and you will not be able to hide it because on the blockchain. So definitely, yes, we are seeing more and more use cases on these sectors.
So in the future, we will see more use cases in healthcare as well for the blockchain technologies. Nicholas, so for the Dubai, because Dubai is geopolitically, it is located in between Europe, India, Asia. Let's say it's connecting the global north and global south, where we are talking about when we are talking geoeconomics and innovation nationalism and other areas. But Dubai also has special purpose vehicles, like in terms of business, to give market sophistication and business sophistications for the entrepreneur. Cross-border capital mobility is one of the Dubai's key strengths. How are you seeing regional and international investors structuring their exposure to digital assets and private equity or real estate opportunities originating from Dubai?
So when His Highness Sheikh Mohammed bin Maktoum created Dubai, his first words was, build it and they will come. And he started building a few things that put the country on the map, whether it's a Palm Island, the tallest building in the world, the largest mall in the world. And the rest of the world laughed at him, saying, you're in the middle of the desert. Who's going to come and do this? And then he built a financial city in the middle of the desert in an oil economy. No oil economy ever had a financial center in it because you didn't need it. You turn on the taps, money comes out. Why would you try to develop infrastructure, vehicles, and funds and banks and these type of things? But he had a vision because he realized that little by little there was a diminishing value to the amount of oil that the UAE had, and specifically Dubai, and that he needed to create a purpose for people continuing to come. And the development of the DIFC, which is now recognized on par with the Singapore or Hong Kong or New York or London, allowed people to not only come to Dubai, built with the amazing airlines that we have, or Jebel Ali Harbor or Sheikh Rashid Harbor, which were also some of the first infrastructures that were developed by the UAE in order to allow people to arrive here. But once you were here, you needed to create more and more economic opportunities and possibilities. And today, the regulation that we find at ADGM or at DIFC allows us to create vehicles which not only protect people financially, but legally and from a regulatory point of view, which is recognized not only at a GCC level, but at a global level with standards that can compete with ESCA or with MAS. And these vehicles allow people to come here, to invest, to set up things that are not only recognized, but can be sold internationally at a benefit which no longer exists in certain Western economies, if we see the state of the US economy today or the state of the European economies, I mean, most of the people in this room didn't come here for the weather. We came here because economically and geopolitically, it's a lot more interesting to be here at the crossroads of Asia, Africa, and the Western world with a regulatory and a tax environment that is beneficial to investors and not punishing them. I mean, I come from a country where they want to increase the inheritance tax, which is already at 50%. So when you realize that your wealth is being given away to the benefits of others, you will go to an economy where your wealth is given to those who deserve it. A meritocracy, which is what Dubai has been built on.
Thank you. This was really comprehensive answer to understand the Dubai's vision. Alvaro, with increasing clarity under Virtual Asset Regulatory Authority and Dubai Financial Service Regulatory Authority, family offices are exploring tokenized assets while managing risk through better due diligence and diversification framework. So my question is to you, for family offices and institutional investors, digital assets still carry a perception of volatility. How should investors approach due diligence and portfolio diversification when exploring opportunities in Dubai, alternative assets, and blockchain markets?
You will be surprised how many times I got this question.
Like
every time I'm now a new family office, they are asking me this. I always recommend to have a balance between two different options. One is the traditional way, investing in early stage startups, which in Web3 they change likely. In the due diligence is slightly different than in traditional startups, but still you might be more comfortable doing this. But the rate of success in Web3 is quite low, way lower than in traditional startups. The risk management is totally different. How you assess the risk is completely different. You cannot put a person in traditional finance to evaluate another risk in Web3 companies. It will not work. We saw it many times. Then what I recommend is while you do this, you will keep a balance doing what is now the new trend, liquid assets, tokenized assets. The why is very simple. You are putting your money for 2, 3, 4, 5 years in a startup that you don't even know if it's going to work. But in tokenized assets, you can quit in minutes, in seconds. You can really make a call to your team and say, guys, we need to get out of this. And you're out. There's no more stocks. At the same time, you might feel more comfortable because these assets are actually traditional assets, are commodities, mostly. I think it's the biggest interest in family office are tokenized commodities, real estate. I think it's the biggest use case in the UI right now, tokenized real estate, and all over the world, but here the regulation is really solid regarding that. So I would recommend to do depending your risk appetite, do a balanced portfolio between liquid assets and traditional investment in the startups in Web3. That's the recommendation I usually do.
Do you see the family office's mindset is changing in terms of traditional investment and alternative investments?
I just told him before in private this comment. I was 2 weeks ago in Singapore in Token 2049. Last year, it was full of venture capitals, some institutions, founders. This year, I would say 80% of the people I met there, they were family offices. Family offices making these questions. How? Where? What? And I'm not exaggerating, 80% of my new contacts there has been family office, trying to get into the space. So the approach is completely different. Usually they used to be LPs in venture capitals, but venture capitals this year has been a disaster. Probably some of you know already, sadly. So family office decide to why we don't do it directly, why we need to go through somebody that now we don't trust. So let's learn about this and let's put the money directly. And that is something that you can do with the real world assets. You couldn't do it before.
Yeah, exactly. So we are talking blockchain, Nicolas. So blockchain is making more transparent as Alvaro was emphasizing here, and it's easy to liquidate the assets. So we see in Dubai real estate because, yes, family office is really traditional model and they are really stick to those mindset and want to try the market blockchain area with the real estate. And we have DLD Dubai Land Department. They have tokenized assets and we can have now fractions of one of the Jebel Ali villas. We can own it with the blockchain. So my question is, digitalization is reshaping traditional asset classes, from property tokenizations to blockchain-based private market access. In your view, how is your convergence influencing liquidity, transparency, and investor confidence?
For us, the biggest change with the tokenization and the blockchain is the ability to fractionalize and the ability to liquidate assets. As you said, family offices are usually one generation behind. It depends how long the people live in your family office and the amount of influence they are able to continue to exert or willing to hand down. Any of you in family offices know that the previous generations don't like handing down influence, so you're usually one generation behind in terms of technology. The advantage we have now is that being very heavily invested in equities or in real estate, which are usually 8 to 10-year funds, highly illiquid, by tokenizing these funds and by fractionalizing them, we are able, as Alvaro was saying, able to liquefy a position very quickly, something that we were not traditionally able to do. And modern investors today look at access to liquidity and transparency of investment. They're not willing to put money into a fund for 8 years and forget about it like previous generations were willing to. They are, because of the advent of technology, everyone's got a portal where you can track every second your investment, which is great when you're into stocks and bonds. But when you're into private equity and you're growing a company over 8 years, if you check in every 20 minutes, you're not going to see much, and it gets extremely frustrating. So the mindset of being able to embrace such technologies allows us to transform our existing investments into something which is more appealing to the modern market. And the underlying product doesn't need to change, but simply what you're doing is the underlying technology to the existing product changes. So you have a more efficient, a lighter, a more transparent product, which appeals to a different market and to a younger market, allowing you to diversify. For us as a traditional family office, when we were managing our own funds, everybody's criticism was their own problem because guess what? It's my money and I do what I want with it. Suddenly I'm a multi-family office and there's another bunch of families going, no, I want this, which is still okay at that level because they're usually as old-fashioned as we are. It's when you become a fund management company with a 3C license and you start getting institutionalized investors and younger investors, tokenized blockchain investors, people who are on a different technology and level of advancement of thinking, that you need to be able to respond swiftly and to show them that you've understood the advantages of their technology, but that doesn't make your strategy wrong. Your strategy can still work with an underlying technology that adapts it and allows your product to enter into the next century.
Thank you, Nicholas. So we are coming to end. This question is for Alvaro, because Dubai regulatory clarity and community-driven innovation seems to be accelerating capital formation in Web3 areas. What advice would you give investors looking to engage early with promising digital assets, ventures, or ecosystem builders in the region?
Well, the biggest advice I would say is, and I'm really sorry to say this, but what you have been doing all these years in traditional investment, it doesn't work. It's not work like this in RWA, doesn't work like this in Web3. Traditionally, the capital is what dictates. If one company get a big capital backing up, you know this company is gonna go far. It's gonna become a next unicorn. Doesn't work like this now in RWA, doesn't work like this in Web3. In these new scenarios is influence. It's influence and narrative. And then capital will follow. And I will give you some examples. Hopefully most of you are aware of Hyperliquid. You know what it is? Or the recently Aster. They got billions in investment, billions, after launch. Not before. They built with very small amount of money, but they got the right people talking about, the right people using the network to promote it. So the capital went behind the idea. I would say follow narratives, follow your gut feeling with the founders, follow the network, because it's all about influence. If you get the right network to promote and the charismatic founder, the money will come after, this company is gonna take off. So forget about the traditional approach. And I would say you will need somebody new on the team with a fresh approach, with some knowledge. But this is my biggest advice from our personal experience. Yeah, that would be my biggest advice.
Thank you. Nicholas, what do you think? What's the biggest advice or the most important advice that you can give for the family offices, because they are thinking about capital flow for generational weave, how to balance traditional weave and new approach?
I think the biggest advice, and having suffered from that myself, is to be open to change, to be open to new technologies and not to stay within your legacy system. Many of our family offices say, I've been doing this for 100 years. If I never change, I will succeed. That's pretty much what the French army thought during World War II, and we lasted 2 weeks against the Germans because we didn't believe in the innovation of tanks and planes. So as a family office, what you really need to do is to look at these underlying technologies that we've been discussing and to say, okay, I'm not going to overthrow and revolt the entire way we've been working, but how do I adapt these technologies to make myself more efficient, to make myself leaner, to make myself more competitive? Because if I'm not looking at them, my competitors will be. And I'm going to be running on a diesel engine while everybody else is on an electric or nuclear power. So the key is to be nimble, to be humble, more importantly, to accept what we don't know. And the older the family, the less humble we are, which makes it a big disadvantage for us. But we need to just step back and say, okay, maybe these young guys with their Bitcoins and their blockchains and their tokens, maybe there's a story to tell behind this thing. And not to disregard what we would still call non-traditional finance, which I find offensive to the new generation, because it doesn't have to be. What was tradition 100 years ago is not the same tradition we have today, and is not the same tradition we're going to have tomorrow. So let us be open to change. Let us embrace it in order to not only be able to preserve our wealth, but not lose it all.
Great advice. Thank you very much. As technology change, our investment world is also changing. We are seeing this in the corporates and governments, different governments, and even BlackRock, biggest investors in the world, they are saying we are going to tokenize most of the financial assets. So it's better to watch this space very clearly. And Dubai it's obvious leading on regulation pace, and I see this investors' trust and clarity on this age, because this report is also showing we are in this region investing more in digital assets considering the rest of the world. Please join me thanking this exceptional panelists, Alvaro and Nicholas, today.
Thank you again to our panelists for that fantastic forward-looking discussion. And thank you, Ms. Amin, as well, for keeping the audience warmed up during a quick, brief run out from myself. So as we go forward, we're going to continue with our company presentations. First up this afternoon, we have Party Guru SRL. Please welcome their founder and CEO, Marino Maggiurini.
Hello, everybody. I hope after the native speaker, are you ready for an English Italian version? I start with one question. Have you ever tried to plan a party or event, a private event, and realize how stressful, expensive, time-consuming it can be? For example, birthdays, weddings, bachelor party, graduation. They all take a lot of time in calling, comparing quotes. The organization is fragmented. Today, we need an all-in-one solution. That's where Partiguro comes in. From chaos to just 4 clicks. A booking.com, just for an easy explain, a booking.com for private events, okay? You can choose your ready-to-buy event packages, okay? Fits on your needs, okay? You can customize, no more hidden costs because you have an instant pricing. You can book, receive the confirmation, and choose and pay how you want, okay? Share payment, installment payment, okay? Only one solution. Now we buy a birthday together. You have a list. First click, you customize, okay? Then you choose the payment. That's it, done. You booked a birthday party for your child, for your friends, for you, a wedding, so whatever. We work in a massive market, 180 billion market, ready for a digital solution. Believe me, ready. With an annual growth of 9% approximately until 2030. So this is our TAM, SAM, and SOM. We want to achieve to the addressable market, okay, to our achievable market is 18 billion euro. So a huge white space for a digital solution. A really huge white space. As a booking at the beginning, I hope to. Another question, can events be sold online? Absolutely yes. We validated in Italy, we sold 100 packages with an average ticket, 778 euro, with 3,000 people involved. So 3,000 people involved with 100 sold. It's important for the referral. 457 supplier on board and B2B subscription testing with a 74% conversion rate. The next milestone, we scale in Italy and we consolidated Italy, then we expansion in France, Spain, and UK. We want to achieve in 2029, 70,000 events sold and 6,800 suppliers with B2B subscription fee. That means revenue of 84 million of revenue, 6.3 million EBITDA, positive EBITDA, and a break-even around now 40. This number with just a market penetration, just 0.5%. I guess it's an important number. Some partner, thank you very much for some partner that built our content. Our revenue business model is a combined B2B subscription and B2C commission, okay? And the future revenue streams for gifting and referral, upselling services, brand and sponsor partnership, advertising revenue, because our customer base, it's very interesting. So recurring plus transactional is that's our sustainable growth. Our go-to-market strategy, it's clear. Phase 1, validation and early traction, we did it, okay? Phase 2, we scale in Italy and we consolidate the model and we replicate the model in Europe, France and Spain soon. And we have a bridge with the United Kingdom for the globalization. Validate in Italy, scaling across Europe. It's a viral model engineered for global expansion. The competitive landscape, no one offered the same that we offer. No one have an all-in-one platform. Because all the customer, all the competitors, you say that, do just a part of the purchaser, just a part of the chain behind a party organization, okay? So we are the first platform combining B2C purchase and B2B monetization in one platform. Our team, me and my co-founder, works for 9 years in a vertical, Denote Worldwide Wedding Wear, in a vertical for weddings marketplace, one of the competitors we saw before. And Michele, our CMO, ex-team leader in Google. We have the rest of the team cover technical, compliance, and finance. Our board advisor is come from top company in various markets, for example, food and consumer, from Nestlé, from Eidos Media, Tech and Media, and they support our growth. So together, we want to build the new Booking.com. I use this example because it is easier to understand for the private events. Yes, now we are in a round phase, seed round, okay? Is mixing equity and safe, 3 million, up to 10 million valuation cap, okay? Mixing safe notes and direct equity share for lead investor. We just planned a Series A in at least 24 months, okay? Okay, that's our idea to capital allocation, okay? Tech and product, marketing growth, J&N compliance, and we save a reserve for expansion and Series A. Seed round open now, so a bridge we already planned. In short, we are digitizing an industry that needs the digitization. So today, the event industry is still 80% offline. We turn online all the chain from when you're searching, find, and enjoy is our payoff. Because we validate a model that is scalable and profitable. So for this reason, we are able to build a new Booking.com for the events. Thank you very much. And sorry, Matt, I'm not able to stay in the stage and to speak in English. Thank you very much again.
Thank you so much for that, Marino. So next, we hear from Sidalix, a deep tech company building the next generation of security. To explain how they are securing our critical infrastructure, please welcome their CEO, Holger Arends.
First of all, thank you very much for coming and staying. And today, I want to start not with this scientific example. I was yesterday in Saudi Arabia. I started to book my Uber, and from one second to another, I got a message. Your day pass is actually expired. And it says, I'll go to your app and actually top up your day pass. It's very funny because when you have no connection anymore to anything, it's very hard to do that. And that is actually the problem what we are looking into. So when I'm talking about radio frequency, it's anything what you're using. Yeah, your phone, for example. And you see the lady here in front, she uses cellular, Wi-Fi, you use Bluetooth, or one of the bigger problems is, for example, as well, GPS. And there's a lot of GPS poisoning at the moment happening. And GPS is not just used for navigation purposes, as well for time synchronization. And when you bring something out of order, it can't actually establish secure channel anymore. And these are all the different small things what you can do to actually stop things from working. And we have many VCs here, and we were talking about the risks of investing in towards future, and we're talking about Web3 and whatsoever it is. It's all useless when you can't connect. And we have, for example, the market forecast of smart cities by 2030 of $3.7 trillion US, and that includes all the stuff. It's not our 10. It's just your investments in towards this future. And that has to be protected. And as mentioned before, you have all these little things like no connectivity because of some kind of an interference or so. But there is as well this super examples like the highly sophisticated attacks in Lebanon, where there was a supply chain, and it was triggered over the communication infrastructure of a foreign country to actually does what it did. And the other thing was a very simple attack against the Polish train network by sending just a simple message over the air with a few $100 device. And every train which was receiving that signal made an immediately stop. And it took 7 months till the perpetrators have been identified. And these are just these things. Imagine now you invest in towards all this AI, and somebody is disrupting all the time here and there your communication, all your company values going down, and nobody is there to actually figure out where's the problem. We have someone like the regulators, but they use this highly sophisticated knowledge and technologies to be spot on a particular case. It's not scalable. And in fact, our organizations itself, they are underprepared. The knowledge is not there and the technology is not there. And that is actually where our technology comes in. So we use knowledge augmentation from an entire team, what is necessary, which you find in government institutions, and as well the highly sophisticated technology you need to configure this and bring this in towards the hands of the civil defense. That means companies, infrastructures, and so on, and to actually prevent what I was just talking about and to secure the investments. So how do we do this? We just collect different kind of radio waves or IP, that is the typical internet protocol. We can follow up signals up to many, many kilometers, and you can find where it is, if it's moving, if it's elevated or not. And all this information is very valuable. And while you're walking around here, you're sending all the time information. Where's my car? Where's my home network? Where's whatsoever, my headset? And those signals can be actually found very, very far. So one of these use cases is actually for critical infrastructures in the physical security. So that means here's one of the stations, and there's 850 gold mines or diamond mines, and they have very large perimeters. They have this LIDAR fences, this laser fences, and there's no physical fence. But there is, like in Australia, we have camels there, if you know or not, and other wildlife, and they're triggering all the time this kind of responses of the physical security teams. So what we are doing, we give this additional information, say, hey, that's somebody with a military radio, these guys are dangerous, or that's somebody with a phone, that's most likely some hiker or whatsoever. So you get this information that makes it very valuable. I'm sorry. Then there comes the other use case, and that is one of the predominant reasons we are in the Middle East. And that is, here's the future. And we know that, and we see this with the robot taxis, for example. And there is quite a lot of investments, but there is not yet, and I'm wondering because we see the GPS attacks, as I mentioned before, all the time happening. So that means the threat against our infrastructure is happening every day. And we have not the tools on hand. And so we are building this infrastructure and providing literally all this information, like you can search, where's, for example, a safe hotspot. When something happens like yesterday, I know that I can connect with my phone to something and I'm not at risk. Or where's might be this base station faking. That means once you connect with your phone to this, they extract the IMSI, that is your identifier on your SIM card, and when you have it once, you can follow yourself everywhere in the world. You just type it in a database and you see where you are. And these kind of information from when two connected cars had an accident, and insurance wants to know, was there some interference which was stopping the sensors, or any kind of information when you want to expand your network for GPUs for gaming, where is the best position to have that? And these kind of information we are actually preparing over AI in data sets relevant for the people, and then sending to the robot taxis. There's no GPS poisoning, and you as a guest don't end up in the sea instead of on your target. And then the market is massive. So I know you hear tremendous TAMs and what sums of 100 million, billions dollars. So we were looking here in the calculations, what is really the target? And we have a focus on a lot of different kind of sectors, but the good thing is we are using the same technology for different use cases all the time. And that makes it very scalable and very interesting. I know we heard a lot that everyone is unique and so on. I have a similar message here. So where we have been in GISEC and LEAP and all these different kind of conferences, we haven't seen anyone like us. And that is the reason that we have so much interest in Saudi Arabia, for example, from the largest companies, and as well from KAUST University, for example, which started to do a research collaboration with a small company from Australia. So it's really nice that we have that kind of speciality, let's call it like this. It's a bit of a challenge, I tell you, because we are early in the curve. However, now people see the problems are real and they're looking for solutions, and there's nothing on the market. We have a very young and dynamic team, as you can see, and the good thing is we are working for many years together. Many people would say we worked in all these large companies. I worked, for example, in Microsoft. Is completely meaningless for startups. It's a different kind of set, but it's important that you have as well the corporate mindset. We have a very experienced and very well-defined advisory team as well in Saudi Arabia and here in the region. And we set that up for the business development as well. We are looking at the moment for $2.5 million to finalize our current development of the products, which we are planning to release in February on the World Defense Show in Saudi Arabia. And we are establishing in both Saudi Arabia and here in the UAE our presences. Thank you very much for listening, and I wish you a great afternoon. Thank you.
Thank you, Holger, for that compelling overview. So our final keynote speaker today leads a company that is building the essential infrastructure for the private markets. We heard from Carter on our opening panel, and now it's my great pleasure to welcome the leader driving their mission across this region. As the Managing Director for Asia Pacific and the Middle East at Carter, Barvik Vashi is at the forefront of their vision to create more owners in the private markets. To share his unique perspective from the heart of the venture ecosystem, please give a huge welcome to Mr. Barvik Vashi.
Hi, everyone. Hope you're doing well. Good to be here with you. Can you guys all hear me okay? Okay, great. So just to get a sense of who I'm speaking to today, how many people in the audience would generally consider themselves an investor of some sort in private markets? Great. And how many operators, builders, founders, startup employees? Okay, about half and half. Okay, great. Super useful. So what I was hoping to share with you all today is some of the data and the insights that we see at Carta to hopefully educate you and allow you to make some more educated decisions as it relates to private markets, specifically in venture, where we have a lion's share of our customer base. First, a quick kickoff from our lawyers, which is effectively, this is no form of legal or financial advice. So please, we're just sharing data. Please infer from it what you will. I'll share my point of view, but it's just a point of view. So the big picture, what we see on our platform, which is, I think, probably of most interest to everybody here, is both what's happening on the startup side or the private company side, as well as what's happening on the fund side, specifically on the venture fund side. And as usual, I see lots of people taking pictures. Please feel free to do so. However, I will note that there's a QR code at the end where you can download the whole report, so you can get it in high definition. I'll start with the company side, and then I'll move to the fund side. So on the company side, basically what you'll see is, this is a kind of a view over the last 6 years. And you'll note that 2025 so far, and this is updated as of the middle of the year, is more or less tracking with 24, which has been more or less tracking with 23 in terms of the number of rounds. However, the cash that's being raised in those rounds has gone down. And so effectively what we're seeing is smaller rounds, which may be counterintuitive to some here, because we hear about these massive rounds happening, especially as it relates to AI. There's a separate presentation that our head of insights has put out in the bifurcation of the AI world and the rest of venture and private equity, and they are two completely different worlds. The AI world is heavily concentrated currently in Silicon Valley. When you see these companies raising, 50 million, 70 million, Series B, A's and B's, that is predominantly happening in Silicon Valley in terms of the size of those rounds. Across the rest of the world, what we're seeing are actually smaller rounds, which then if you flip it, it makes a bit of sense when you think about how much more capital efficient startups should be in theory by leveraging AI as it relates to business operations. And so we see investors and founders kind of coming to terms on the amount of capital that's actually necessary to get to, again, the next business milestone, the next fundraising event. I'll talk about later that we also see bridge rounds continuing to be popular. I think the company just before noted that they were planning their Series A bridge round whilst raising the seed round. And again, that is very common in what we see. So yeah, same thing, different chart. You'll notice that this is kind of broken down by the stage. And so as I mentioned, the deal count is up, the cash is down. The only exception is the seed round. So the seed round is where we do see cash piling in. And again, my point of view on this is the seed round is where we see most of the innovation and true AI native entrepreneurship taking place right now. If you're launching a company in 2025 or 24 and you're raising your seed round beyond your friends and family round, chances are you're AI native. You're going to struggle to fundraise otherwise, is what our data proves. So this is where we see a lot of cash pouring in right now. A lot of investors are convinced that 24, 25, and likely 26 are great years to be making bets, especially at the seed stage where the capital outlay for them is fairly limited. And when you think about their portfolio theory, they're really maximizing shots on goal, right? So they are looking to make, early stage investors can make 30, 40, 50 investments out of even a small fund with small check sizes and hope that one or two of them hits and power law applies. And so this is why you see a lot of cash pouring into seed stage. Otherwise, as I mentioned, you'll see rounds going up for the most part, especially when you look at quarter over quarter, but the cash in those rounds is actually going down. The other piece that I mentioned again is bridge rounds continue to be very popular, and that a majority of capital raise is and continues to be primary fundraising. You may see in the news a lot of secondaries happening, and obviously there are some well-known late-stage private companies, Stripe, OpenAI, Anthropic, et cetera, SpaceX, where many people in the room, especially on the investor side, may be seeing, hey, I've got a block of secondary, do you want to get in on this? And it's a brand name. And there are, I think there's a bias in that you hear about those secondaries often, and so then you may assume that secondary activity is rising, but the data proves otherwise. We see a few companies that are funding themselves late stage through secondary, but overall primary fundraising remains the most popular way of fundraising for a company. Valuations, and this is probably one of the areas where I think both companies and investors, but certainly investors, can be a bit optimistic. While other areas are relatively flat, we are seeing that median valuations are starting to rise. So we had this huge bubble, as everyone is probably well aware, during the ZIRP era, where effectively the cost of borrowing was zero. And so you just saw private and alts valuations skyrocket, 21, 22 particularly. And then there was a crash. The reality is it wasn't a crash, it was a regression to the mean. If you extend the chart back to 2015 or even back to 2010, you'll see we kind of just went back to normal. And so now that the valuations have substantially reset, you're starting to see them climb up again. We also see a cohort of companies that, as I mentioned, continue, especially late stage, that are stuck in kind of this bridge round situation where they raised at a valuation that they no longer can support on a primary raise. And so either their existing investors will come in to extend their life, or they become operationally efficient, cash flow positive, such that they don't have to raise anymore. But that's primarily a phenomenon in late stage companies. Valuations, again, as you see in the early stages, are climbing. Particularly, I'll call out Series B, where we see notable increase in kind of the median valuations. But even, again, when you look at the late stages, you are seeing a climb across C, D, and even E is notionally up from Q2 2023. So as an investor, you can feel comfortable, more comfortable with the prices that you're paying for startups. Again, putting AI aside, because there's just a whole bubble going on over there. But otherwise, you can feel comfortable with the prices that you're paying for companies these days in private markets. And then one other kind of topic that's usually top of mind for everyone is liquidity. I think liquidity has been a challenge. It's kind of the elephant in the room when it comes to private market investing and certainly venture investing. We continue to see M&A activity at all-time highs as a way of creating liquidity in private markets, which we think is critically important. And if you think about all the things I just said in terms of less cash being required to grow a business, more rounds happening, and the fact that valuations have notionally reset, that actually plays really well for M&A. Because in an M&A situation, a strategic or even private equity can come in and actually buy an asset as at a reasonable fair price with a reasonable amount of capital, and most of them will take some leverage in that transaction as well. And then there's a very clear way to underwrite how you flip that. And so we see M&A increasingly common. I think the easiest chart to see is probably the one on the left, where you can just see Q1s from 2019 to 2025, for example. And you can see that Q1 in 25 was the most active quarter we've ever seen in terms of M&A. So that's the company side. What does this mean on the investor side? And how should funds think about this? How could high net worth individuals, family offices, and LPs think about this? And then how do LPs also think about fund performance in the context of what we're seeing at the asset level? So I'll talk about some of the kind of common fund metrics. Many people don't know, people know Carta as a cap table and equity management company. We're also the world's largest venture fund administrator, which basically means we operate the back office for venture funds, and therefore we have very high quality audit defended data available for those funds, which is where all of our insights come from. So we'll look at IRR, TVPI, DPI, some of the metrics here. We're going to look at net IRR by vintage year. So what you're seeing on this graph is basically the spread between the best funds, the worst funds, and kind of the median funds. And so you'll see that broken out by the quartiles. And then you're also seeing it broken out by vintage year. So what is the year that the fund started? From 2017 to 2024. It is normal to see that more recent funds have lower IRR because it takes time, obviously, to generate returns. The time horizon on venture investing used to be 8 to 10 years. Many will argue these days it's 10 to 15 years, although you're starting to see, as I said, more M&A activity that could bring that back in terms of creating liquidity and actually creating DPI for your LPs. But in short, 2017 to 24, again, you'll kind of see that step down. The trend that's more interesting, I think, is, as I mentioned, 21 and 22 were historically frothy years. And so if you think about how much money pumped into the ecosystem, actually in the absence of a technological innovation, I often wonder, had 21 and 22 happened at the same time as AI, that would have been crazy. It's actually very healthy for us that those things were sequenced and they didn't happen at the same time. Otherwise, we'd be in a world of hurt. But in 21 and 22, you saw so much money pour in and such high valuations that it actually proved very difficult for funds to then return on that. But you'll see that that curve kind of starts to invert when we progress out of 21 to 22, 22 to 23, where you're seeing IRRs pick back up. And so in many ways, one way of interpreting this is the worst is over. At least this time around, and you're starting to see that pick up. Again, 24 is just too soon, I think, to create IRR, but we'll look at TVPI as well. Yeah, so this is kind of my point. It stopped falling for 2017 and 2019 vintages. IRR is also just a moving metric. So every quarter we put this out, the 2017 IRR keeps changing, right? And so that's also an interesting thing to do, which is to look at how has that IRR been changing quarter on quarter. And so if you look at, again, the top, you'll see that the 2017 IRR and the 2019 IRR has stopped falling and is actually starting to level out. The elephant in the room as it relates to venture these days is DPI, which is effectively, do the funds actually give money back to their investors, cold hard cash? Does it ever make it back to the LPs? not going to sugarcoat this. There have been very, very few funds, statistically speaking, that have actually returned money to investors in recent vintages. That's not completely surprising. I just mentioned that you generally expect the time horizon of a venture fund to be 8 to 10 years traditionally, and in the middle we saw that really extending to 10 to 15 years. So it's not surprising that 2018 and beyond is just not actually distributing money back to investors. However, I would also note that what we see in the LP ecosystem is this is a frustrating dynamic for their portfolio. And because of the investments they made in 21 and 22 that they think they may never get returns on, they're actually encouraging and pushing fund managers to, dare I say, artificially create DPI, especially when you think of the venture asset class, on both the 20 and earlier funds, as well as even the newer funds. So you're seeing certain, seed investors that I've met with in Singapore, Australia, where it's a 22, 23 vintage, and they maybe made the seed investment, they're exiting at the Series A, right? Or even at the B. And they said, well, I have to provide some distributions to my LPs. That's what's going to allow me to raise the next fund. And so it's a very interesting dynamic. And I have a lot of thoughts about this because I think that if you're looking for DPI in venture within 5 to 7 years, you're actually in the wrong asset class. Again, when you think about your overall portfolio, there are other ways to get distributions. Private credit is one that is becoming increasingly common. Public equities are a great place to have liquidity. Anything, with yield, but venture, not so much. That being said, this one always shocks people. But this is kind of what the data says. So yeah, as I said, just over a third of 2019 funds have returned any capital at all, period. Which again, like I said, is not that surprising, but it is always shocking, especially in the LP communities where I present this data. I think what we're trying to do is not scare LPs away, obviously, from private markets. That would be bad for us and everybody else. What we're trying to do is educate them on the asset class. And you'd be surprised how few LPs truly understand the asset class as it relates to their overall portfolio, especially, not to call them out, when you think about high net worth individuals, family offices, folks that are relatively newer to privates. It's kind of like Vegas. You see somebody go win, on blackjack or craps, and you're like, oh man, that's amazing. I want to get in on that. But statistically, that's not going to return. It obviously makes sense for the sovereign wealth funds and pension funds and others as part of diversification, but the math is a little bit different, obviously. And so this kind of proves that. TVPI is probably the best leading indicator because this is effectively what is the fund marked it at versus what they invested. There is obviously a huge confounding variable here, which is that the fund is the one that marks the asset. And we can get into conversations about valuations and regulation in that space later. But that all being said, most of the funds are marking up their portfolios. So that's good if you believe it. That means effectively, if you're over 1x, it's just saying the net asset value of the fund is greater than the paid in capital. And so they are saying that they are, quote unquote, in the money still on paper. And it's just a matter of actually then getting to liquidity events to create the DPI that I mentioned to then turn this into real returns for investors. And we won't know for at least 7 to 10 years. So this is the best thing we have in terms of a leading indicator. And again, that median TVPI has stopped falling. So there was a period of markdowns happening. A lot of people just held steady, frankly. And some companies survived and other companies shut down. And obviously when a company shuts down, you do have to mark it down. But if a company's alive, you don't have to mark it. In the US, there's this concept of a 409A that at least at the asset level, you have to mark the company every year. But that also doesn't always line up to the fund mark. And then internationally, we see that it's even more loose in terms of the regulations around valuations. So what does this all mean? And how can we capitalize on the opportunity ahead? As I mentioned, this is not legal or financial advice, so I leave that to you and your interpretation of what you want to do here. As I mentioned, my personal point of view is this is how venture has always been. In fact, nothing has really changed other than we just went through a remarkable hype cycle and then a regression back to the mean, and there's been a lot of discussion around it. And there are a lot more participants in it today than ever before, but the asset class, the dynamics of the asset class have not materially changed. And so it is what it is. If it's for you, if it makes sense for you, then for sure, we encourage you to participate. And if it doesn't, that's, I think the data speaks for itself. You have to be a long-term horizon investor for it to make sense to participate in markets. That being said, we also see over the 20-year that the top, not even the top decile, but the top quartile private market funds still outperform S&P 500, which is the stat that everybody uses as the ultimate test of whether the asset class is worth its weight or not. Thoma Bravo is a great example as a private equity firm, consistently outperforming S&P 500, top decile of venture funds, even top quartile venture funds. We also see that emerging managers, the way we define those are people who manage less than 100 million, are consistently the highest performing fund managers, counterintuitively. So when we have periods like this, often people flock to brand names or stability. That's inherently paradoxical when you think about venture. So if you're looking for a Lightspeed or a Sequoia to invest in, you're actually these days investing in growth PE. You're not investing in the counterintuitive, idiosyncratic, find a diamond in the rough, which is the basis of venture. Emerging fund managers who are usually regional or even fully domestic and very niche in terms of a vertical like fintech, Web3, etc. These are the ones that outperform. They're also the ones that don't perform. So there's a huge spread on the top decile, top quartile, and the lower quartile. But that is, if you're ultimately seeking alpha and that's how you think of venture in your portfolio, then our data does support that theory. That's all for me. I think you all kind of are familiar with Carta, but I will just share the QR codes that I mentioned earlier. Our whole job is to make private markets operate more like public markets. So the more that we educate folks on the data and the more that we provide tooling and software infrastructure, we think that we can get people to participate in a more sustainable way in this economy, which we think is a good thing. Most people don't realize the majority of the world's wealth is actually in privates, not in publics, and that the US stock market is somehow 50% of public markets, even though it's a fraction of GDP and actual economic activity. So I'll skip through some of this, but we serve fund companies and LPs, and that's kind of where we get all this data. So if you're wondering where the data is from, it's obviously from our customers and our users. And the last piece is leave you with these QR codes. So everything you saw today, you can download it by scanning either of these QR codes. We have the state of private markets, which is the company side data. And then we have the fund performance report, which is, again, the fund side data. So yes, encourage you to consume this. And if you like this stuff, you can just subscribe to our mailing list so you always get the freshest data from us. I'll leave that up there. And yeah, thank you all very much.
All right, ladies and gentlemen, that brings us to the end of venture capital. And by the way, Bhavik, I'm so glad that there's no hype in venture capital anymore. Just joking. It's like you go through that hype cycle of 2020, 2021, early 2022, and you think, okay, now it's going to be reasonable again. End of 2022, AI comes along and we just go back to flat out insane. So I just want to say a big thank you to everyone that come along. Please, if you were introduced to this event by someone from another country that's a subscriber of ours, please say thank you to them. I know that a lot of you have been referred to us, or you've sort of found us in your own way. How we grow is by other people sort of introducing to what we do. We're going to be looking to do our next event in Dubai at the end of March. And we want to say today we're really, really pleased with how today sort of come along and the networking and, the attendance and so forth. So we want to take this to another scale next time we do it. We'd love to do a 2-day event. So if there's any sort of partnership opportunity, network opportunities, feel free to reach out to me. You all have my email at this stage. So, ladies and gentlemen, thank you very much for joining us at Venture and Capital Dubai. Have some great networking. Speak soon.